Those who are attending virtually also, I welcome you. So friends, today we are going to discuss about care and compliance in undertaking capital transaction in tax laws with our past chairman, sir, Gautam Doshi, sir, who is here. May I request you, sir, please join on the dais. Friends, we at WRC is highly committed to empower our members with various opportunities, knowledge sharing. So in this series, recently we have done National Conference on Internal Audit and our regional conference on a future ready CA theme. So today we are going to discuss again a very interesting topic. And I want to say that we are living in a different era now. The way of presentation is completely changing. We are in digital era. We have to submit our representation through faceless assessment appeals. So we need to change ourselves according to the time's requirement. So with this, first, may I invite virtually CA Rahul Parekh sir to introduce our today's speaker, Gautam Doshi sir. Rahul bhai, over to you.
Thank you, Saurabh bhai. It is indeed a pleasure to have the privilege of introducing a very great luminary in our profession, CA Gautam Doshi sir. He is a chartered accountant and a master's in commerce, has an extensive experience of more than 45 years. He has been acted as an advisor to various industrial groups, families, and also serves as an independent director on various leading public companies and listed and unlisted, including Sun Pharma and Pyramid Capital. He has wide experience in areas covering mergers, acquisitions, direct, indirect taxation, international taxation, transfer pricing, and a wide area of experience. I know he doesn't need much introduction to our fraternity, but still it would be a privilege to do that. He's been actively involved in conceptualizing and implementing a number of mergers and restructuring transactions in domestic as well as cross-border companies, and has been involved in the top 20 listed companies of BSE, as also those forming part of the FTSE 100. Of course, he has addressed various seminars and conferences in and outside India. He has been a member of the WIRC as well as the Central Council. He is a past chairman of WIRC, and during his tenure, he has been a part of the several committees and has contributed significantly to the Board of Studies. So with these few words, a great pleasure introducing to our audience CA Gautam Doshi. Welcome, sir.
Let's have a big round of applause for our learned speaker of today's session, CA Gautam Doshi, sir. May I now request Treasurer WRC, Piyush Bhai, to present a moment or two, sir. So wish you a happy learning, all of you now. Sir, over to you.
Thank you. And thanks to WRC and to all of you for inviting me here to discuss, as was mentioned, a fairly interesting topic, a slightly different way of looking at it, care and compliance in undertaking capital transactions. It is, of course, too vast a subject to be able to deal with in the course of 1 or 1.5 hours of time. Let's are the highlights which we can talk about, because capital transactions cover such a vast area. Shares, debt, when you talk of shares, equity, preference, hybrid, issued for cash, issued in kind, any number of variations. Similarly, any number of variations in debt. And then you are talking about raising capital, returning capital, servicing capital. And therefore, I have avoided and I have not dealt with dealing in capital in the sense of transfer, etc. Because that I think is a separate subject. When we are talking about capital transactions, I would talk about raising capital, servicing it, and returning it. Those I think would be the key elements. So we would talk about, as I said, shares or debt, securities, a variety of them. Let's deal with that. So the first, when we talk of capital transactions, the first thing which comes to mind is shares. And therefore, let's talk about issuing shares. So you could either issue shares or you can issue warrants, which are a analogy, similarity of shares, but not shares. Something which entitles you to a share, as in when you want it, but it is not a share. A share is a share. So it's a part interest in the ownership of an entity. But that's really true of equity shares. Preference shares, as we all know, and as we ourselves as accountants in the context of Ind AS treated, constitute really debt. The name given is shares, but they are closer to debt because of their rights, because the rights in ownership of a preference share are not as close to that as of equity. On the other hand, it is debt of the least priority. It is debt, but it is share capital, which would mean that in a liquidation, in a winding up, it's only after all other debt is paid out that you would come to preference shares. So it has the least priority. So it is debt, but it is low priority debt. And now, after the 2013 Act and the 2015 notification to which I have referred, you now have the possibility of hybrid shares. Under the 56 Act, that was not possible. Under the 2013 Act, till this notification, that was not possible. What has this notification done? What it says is, you can, at your option, amend your articles to say that sections 43 and 47 of the Companies Act will not apply to the company. So you can opt out of two sections. These are the two sections which prescribe what is equity, what is preference, what are the rights of equity and preference. That preference will have a preference in dividend and redemption. That preference will have a voting right if they have not been paid dividend for 2 years and so on. So all these rights of equity shares and preference shares, in a sense, are set out in sections 43 and 47. And you can opt out of them. So if you opt out of them, then you are free to design your own shares. They need not be equity, they need not be preference, they can be any combination of the two. And that is why we are calling them hybrid. So, and we'll come to that in a minute as to the types of things which one can do with hybrid shares. But only a private company can issue it. A public company is not allowed to opt out of 43 and 47. It must comply. Therefore, as far as a public company is concerned, there can only be equity or preference. There cannot be a third category. For a private company, you can have a third category. That's the difference. And then we can issue them in cash or in kind. So that's what I have described. Equity shares give you economic ownership, control, etc. Preference shares. And there is a large internal variety when we talk of shares, because if you are going to raise capital, the variety is enormous. So you can have a convertible preference shares, non-convertible, optionally convertible, redeemable. I have mentioned irredeemable. The Act does not allow you to issue irredeemable preference shares. But the Act says that the maximum period should be 20 years, and in the context of an infrastructure company, you could take another 10 years, but there is a maximum period prescribed. They must be redeemable. And because they are redeemable, we are referring to them as debt. Because one day or the other, in a sense, you are supposed to pay the money back. But in practice, you can have irredeemable preference shares. There are two routes by which irredeemable preference shares may come into existence. One is in an existing company, when certain rights of shareholders are modified, you could modify them such that an equity shareholder becomes a preference shareholder. But he started as an equity shareholder as irredeemable, and he may continue as irredeemable. Because if he becomes redeemable, there is no clarity, but in my opinion, that amounts to a reduction of capital. So one would have to comply with both the conversion of rights and reduction. Whereas if you do only conversion, it would be an irredeemable preference share. So that is one. The other is the law prescribes two things. On the one hand, you must issue redeemable preference shares. But on the second hand, it says you cannot redeem a preference share unless it is fully paid. So if you have a partly paid up preference share, what do you do at the end of 20 years? You can't redeem it. You are required by law to redeem it. But you can't redeem it because the law, same law tells you that you can't redeem it unless it is fully paid. You can make a call on the shares. The shareholders may pay, may not pay. If they don't pay, you can forfeit. But let's say you don't make the call because you don't need the money. Then the preference shares will continue. The partly paid shares can continue. In that case, they become virtually irredeemable. And there is, of course, the provision under that section, which permits at the end of those 20 years, if you can't redeem, you can virtually issue a new set of preference shares to redeem the old ones. Effectively, it becomes irredeemable. It's just another name given to it. So these preference shares are replaced by new preference shares, but they continue. There are conditions attached, NCLT, approval, etc., etc. But some of those conditions are, again, practically impossible. The condition is that if a set of shareholders who hold the preference shares say that I don't accept this option of taking new preference shares for old, they must be paid off. But you have gone to NCLT saying I cannot redeem them because I don't have profits. I don't have reserves. I have made losses. What does one do? That section says that redemption can only be out of a fresh issue or out of reserves, out of profits available for distribution of dividend. Again, you are hit with the same section giving you two conditions. One saying you must redeem, including now an order of NCLT telling you must redeem. And another saying, before you can redeem, you must have profits or you must do a fresh issue. It's not, how do you compel somebody to pay money in a fresh issue? What if he refuses? You can't. So there is this possibility of uncertainty. So that is why I have referred to irredeemable, long dated to refer to the 20-30 year. Because at times, if you really have long dated preference shares, 20 years, and there are a number of preference shares which are issued at say 0.1% dividend. So by 0.1%, what you are really saying is virtually no dividend. There are some who issue it at zero dividend. I'm not sure they are preference shares. Because in law, preference shares must have priority in dividend and in redemption. If they are 0%, then there is no priority in dividend because they don't have a right to dividend. In that case, they are not perhaps preference shares. And if they are not preference shares, I'm not sure you can issue them. I have not found the ROC questioning it. I have not come across show cause notices saying, how did you issue such a share? But on the other hand, to my mind, it perhaps cannot be issued. So therefore, you would have this possibility. But if you have a 0.1% share, which is 20 years, what is its present value? If you have put 100 rupees, I think its present value is something like 20 or 30 rupees, may not even be that much. So effectively, you have given a gift of 80 rupees to the company. That's really one way. That's why I'm referring to them, because you often want to raise capital. Shareholders are willing to give, but you have sections like 56(2)(10) and 56(2)(7)(b and all those, and we'll come to them in a minute, which come in the way, which say that therefore there will be all sorts of tax consequences. To get over those, whether this will work is something which one needs to examine. If you have this type of condition, then you can issue them at par, you can issue them at premium, but premium will have to be justified by the valuation. I've discussed zero dividend and redeemable at a premium. What I mean is, one of the ways of dealing with preference shares is you issue them at premium. So you say a 10 rupee share, 990 rupees premium. So you really get 1,000 rupees. Now, how can there be premium on preference shares? How can a valuation ever justify 990 rupees premium on a preference share? No valuation can justify that on the face of it, prima facie. Why do you do it? You do it to reduce your authorized capital. You do it to reduce your stamp duty. Because if it is 10 rupee share at 990 premium, you are paying only 10 authorized capital on 10 rupees. You are paying stamp duty at times only on 10 rupees. So you are doing this to reduce your cost of issuance. Now, how do you justify the premium of 990? So what you say is, yes, it is issued at 10 plus 990, but it will be redeemed also at the premium of 990 together with a yield calculated on 990 at say 6% per annum for the period. So if it is redeemed after 10 years, 6% compounded will be added to the premium. So it will be redeemed at 990 plus 6% compounded on 990, which may make it say 1,800 on that day. So you're really saying it will be redeemed at a premium of 1,800, not of 990. Now, if you put this as a condition, then can you say that the valuation of 990 is justified? I think yes. In such a case, you can, because this preference share entitles you to whatever you get at a 10 rupee share, plus a right to a redemption at that premium. So it subject to the only factor being the uncertainty about, will you actually see the redemption? Will that money really come to you after 10 years? Will you really get 990 or 1,800? But subject to that, here is a company which is promising to pay you. Based on that, today the payment of 990 is justified. The chances that they will really honor their promise, you discount for that if you like, depending on the company, depending on the company's strength, its financial assets, etc. How much discount you want to give is up to you. But subject to that, you can value it on the basis of the premium. Share warrants, another way of raising money. In unlisted companies, you can have, there is no real regulation on them. So if you want to issue shares, you must complete the issuance within a prescribed time. So from the day you receive the subscription money, you can't keep it pending forever. You have to complete the allotment. But if you receive the money as money for warrants, they can perhaps continue till they are converted. And in an unlisted company, there is no prescription of the period within which you must convert a warrant. In a listed company, SEBI tells you the warrant must be converted in 18 months. And if you can't convert it in 18 months, the warrant will lapse. So in a listed company, that is clear. But in an unlisted company, there is no prescription. So one can take advantage of that. That's another way of raising money without giving it a name. It's neither a share nor a preference share. It is lying somewhere in limbo. All that it means is I have a right to convert it into a share and it's lying there, but I have given money to the company. Till then, I don't have voting rights. Till then, I don't have dividend rights. I virtually have nothing. So there are ways of raising that type of capital. Of course, as far as listed companies are concerned, you will have to follow the SEBI rules. Hybrid shares, as I mentioned, is another class of shares. And that can give you, as I said today, a significant variety of things which you can do, which you can use a company for in a capital account transaction. For example, in a cooperative society, when you buy a flat, you get a share in the society and you get the right to possess the flat in the society. That's how the normally cooperative societies are organized. But you could do the same in a company. You can have a company where you say everyone who holds the shares is allotted a flat and the allotment of flats is proportionate to the number of shares held. So you must hold a minimum of 25 shares to get the flat. So you could link it to a specific asset. And like a cooperative society, you could insist that before he can get the allotment of the flat, he will have to pay for it. So all those similar conditions can be imposed. You have Bombay High Court having dealt with that type of case in Nirmal Commercial's case, where those articles have been dealt with and discussed at length. In the context of a tax case, they have not doubted that such articles can be there. So the articles were there. They were there even under the 56 Act. Now under the 13 Act, definitely it is possible. Or you can have shares which you call equity, but the rights you give them are really preference. So they are irredeemable preference. Because what the rights you have given to those shares are virtually fixed dividend, fixed redemption, not necessarily a preference on dividend and redemption, but fixed both of them and no voting rights. That's a preference share by whatever name called. On paper, you can call it equity. So by calling it equity, you can make it, as I said, an irredeemable preference share. Differential voting rights, differential dividend rights. For every 10 rupees, you can have voting rights for 1,000 rupees. For every 10 rupees, you can have dividend rights only for 1 rupee, whatever you like. It's entirely between the shareholders to work out. There is tremendous flexibility. Cell companies, this now gives the possibility that if articles are properly designed, you can have a company which says that shares of class A will get all the profits of the steel division and shares of class B will get the profits of the chemical division, and the steel division and chemical division will in a sense be virtually two companies in one company. Class A is entitled to steel, class B is entitled to chemicals. That type of arrangement is now feasible. The law in some countries provides for it. You have protected cell companies in Mauritius. The Companies Act provides for it. Our Companies Act does not provide for it. It has negative consequences. Even though the steel and the chemical businesses are separate, a default of steel will hurt chemicals. Whereas in a protected cell, if the law provided for it, that would not happen. So they are not really separate. They are one company. But for all practical purposes, they are two companies. So let's say you have real estate in the company and you have business. And you issue a new class of shares and the real estate therefore belongs to that new class and the business belongs to the old class. So you wanted to sell the real estate, you have really sold the real estate, but you have sold it by issuing this new class of shares. And this new class of shares is entitled to the benefit of the real estate part. So something like this is now feasible because of this hybrid shares. And therefore, as I have said, you can have any number of others. It's your imagination which is the limit. You have to think what type of shares you can issue, what you want to achieve. In that sense, it has given you that freedom. They cannot be issued at, just to clarify, shares cannot be issued at a discount. The private placement versus a public issue, you can't issue to more than 200 people in a, so even if it's a public company, private company, the maximum is 200 members. In a public company, you can have issuance to 200 members, but you can't issue to more than 200 in a year and so on. So these are, you need to make, and this is your compliance, which you need to make sure that you comply. You need to comply with 62 and 42 if you want to do a preferential issue. And the alternative to a preferential issue is a right issue. So there are steps which you need to take, but basically what you are saying is you need existing shareholders to pass the special resolution permitting a preferential issue. Unless they pass that, you can't do the preferential issue. That is the most important condition. So because of that, you are really giving that right to the existing shareholders. It becomes their company, but they can invite a new class of shareholders under a preferential issue and allow them to take the advantage of being part members. And all the paraphernalia around it, separate bank account, give a pass for a letter and valuation report and so on and so forth. One needs to go back to the section and the rules and make sure that you comply. There are number of conditions attached. I mean, in a sense, one can discuss them, but I don't think they need discussion. One has to read them and comply with them. There is no need to discuss them at a forum like this. The fact that they are there is enough for us to know. The alternative, as I said, is a rights issue. That is, you give a right to existing shareholders, they can renounce. So instead of a preferential issue, you can, where you pass a resolution directly allotting to a new Mr. X, you can have a right share and the right can be renounced to Mr. X. Both ways, Mr. X will come in as the new shareholder. So both options are available. The number of compliance issues in a rights issue is much smaller than the number of compliance issues in a preferential issue. But otherwise they are on par. Rights, for example, are available to the board of directors. You don't even need to go to shareholders for approval. In a preferential issue, you need a special resolution. You need 75%. Here, board can decide. So it's much easier to do this as compared to preferential, but both our routes are available. Then coming to some of the tax consequences. If there are consequences on the company, there are consequences on the shareholder. So far as the company is concerned, you have the anti-avoidance rule in 5627B to try and make sure that the company does not get too big a premium, does not effectively get cash, does not effectively get a gift and get away without paying tax. You have the classic case, the assumption being you had companies floated by, say, the chief minister, but in his personal capacity, and say somebody comes and says, I'm willing to buy your shares, face value 100 at 1 lakh. The company is not worth 1 lakh per share. Company is not even worth 100 maybe, but you are willing to pay 1 lakh. Why? The assumption is you are paying that 1 lakh because you are getting some benefit somewhere else. Otherwise, you would not be paying this 1 lakh. So that is one possibility. How do you curb that? So you curb it by a section like 5627B, which says, give a valuation, justify this 1 lakh which you are charging. If you can't justify this, then the amount in excess of the fair value, and if the fair value is 100 only, then 99,900 will be charged to tax as the income of the company. So anything which you do to try and bypass the tax laws can be caught. That's what 7B is trying to say. But 7B, of course, has loopholes, which you would not do. If you were to issue shares worth 1 lakh at face value, 7B would not apply. It applies only if you issue at a premium. But then you would pay the stamp duty, the authorized capital, and so on and so forth. And also the fact that if you have issued at 1 lakh and he is holding that many shares, you would really not know who is controlling the company. Whereas if you issue only 100 rupees one share, naturally your control is not impacted. So that is one. So 7B is coming in the way, is meant to be an anti-avoidance. It goes by rules of valuation. How do you value? You have 11 UA, the book value, or the DCF method to justify. And the DCF method has been the subject matter of a lot of litigation, because DCF is based on projections. I expect my startup to achieve a turnover of 10,000 in the first year, 1 lakh in the second year, and 10 crores in the third year, and 100 crores in the fourth year. No, that's what I expect, because I think the market is there. It's just that I need the time to capture the market. So from 10 lakhs to 100 crores in 4 years. And naturally, my profits will jump accordingly. And if I'm really capable of achieving that, my shares are worth a lot more. And I can charge for them. I can charge a premium if you want my shares, because in 4 years, they will be so valuable. Now, the reality is, I may achieve that. I may actually reach 100 crores. I may not even reach 1 lakh. It's a startup. It's something new. It's a business which has not been tested. I am assuming that this business will give me these results. Nobody can guarantee that. Nobody can assure that. So you are discounting that uncertainty, but you discount it only by 20%. You still pay the value of the share by discounting it by 20%. On the basis of share worth, a company having a turnover of 100 crores and profit of 10 crores. Whereas the reality, as I said, when you fail, it is zero. That 20 becomes zero. What do you do? Naturally, by the time the assessment is being made, the assessing officer is aware that you have failed. That the company is nowhere near that 100 crore turnover. It had promised 1 lakh in first year, 10 lakhs in second year, etc. It has achieved nothing. So he says this whole thing was fake. This whole valuation was fake. 7B was wrongly, therefore he invokes 7B. He says your fair value was only 100. The balance premium which you charged was all uncalled for. And therefore I will charge it to tax. Now this is a litigation which is continuing. It's very difficult to say. Did I bona fide believe that I would achieve this 100 crore turnover? Or was it a way in which I managed to charge a premium, get check money and give cash back? Nobody can find out the truth. The assessing officer is going to charge, and that litigation will go on. One of the two will succeed. Either the valuation was justified or it was not justified. Prima facie, courts have said it was justified, so long as you are able to give a base for it. If it is totally in the air, it's totally in the air. But subject to that, it should work. So this is the type of thing. The alternative is to justify it on the basis of the valuation of assets it holds. And we have discussed preference shares and the type of valuation, for example, the premiums which we want to charge. Coming to the shareholder, this was in the context of the company. Coming to the shareholder's taxation, if he gets too much value, he pays only 100 rupees, but he gets a share worth 1,000. The shareholder should pay tax on 900. So the fair value of the share is equally relevant for the shareholder. But the rule on which he is to be valued is slightly different. the 11 UA rule for the company is based on the book value without revaluation of any underlying immovable property, shares, jewelry, etc. The rule for the shareholder is 11 UA valuation based on the book value after revaluing all the major underlying assets which are specified in the section, which consist primarily of shares and immovable property. Those are the two most important. And then you have a variety of other things like jewelry and yachts and all that, but those are not so important. So it depends on that. You have two different rules. One for the company, one for the shareholder. So when you are evaluating the shareholder, you might say, okay, you got a share worth 200 rupees, so you pay tax on 100. When it is coming to the company, you are saying, you sold a 100 rupee worth share at 200 rupees, so you also pay tax on 100. So you can charge the company also, and you can charge the shareholder also, because you are applying two different rules of valuation to the two different people. Of course, there are, you will have to be able to, and you would be able to work out of it by saying that in the context of the company, the real value is 200 and justifying it and so on. But it is creates unnecessary litigation. For the purpose of valuation, you are supposed to use a balance sheet. Under 7B, you have to use the last published balance sheet. Under 10, you need a balance sheet audited as on that day. If I'm buying shares on the 25th of June, technically I need a balance sheet as of 25th of June. That's not really going to happen. You don't really audit those accounts, and it's impossible. If you really wanted to do that, then 25th June audit would be complete at the earliest, say by 25th July. But then I need 25th July audit. On 25th July, I can't buy 25th June shares. So in that case, you can never buy if you want to wait for that. So you have to estimate and do it. There is only one technicality in my mind. I don't know who has to get the accounts audited, who has to do the valuation. The section does not say that it is the obligation of the shareholder to get it valued. So I could equally easily, if the officer raises a question, tell him, all right, you go and do a valuation audit of this company as on 25th June, work out the number, and then prove to me that the price I paid was too low. But until you do that, you cannot charge me. And you cannot ask me to do that work because it is not my obligation under the section. Nobody has tried it in practice. I have not advised any client to try it in practice, but theoretically it is possible. It's possible to tell the officer, I am not going to do this. If you want, you do it. If you appoint a chartered accountant, go and get the accounts of that company audited as on that day. So one has to, you have a variety of other issues. So for example, in the 11 UA valuation, as I said, you have to value the underlying shares. There are companies which have one underlying subsidiary, second level, third level investment. Up to what level will you go? How many companies will you value? How will you work out finally the 11 UA value? The cost of that valuation will exceed the value of the shares at times. So that's an exercise which is very difficult practically. One has to take a chance. I am assuming that no officer also understands or will be able to do it. So ultimately, one will go by practically whether it looks fair or unfair. If on the face of it, it looks that it is worth 100 rupees you have paid, but it is on the face of it worth 1,000, that would be apparent. But if you have paid 100 and it is worth 120, it won't be apparent, you will get away. That's the type of situation which is going to happen. Then all other issues on 56.210, but I think let us, on a rights issue bonus, that's I think going too deep. The other issue is section 68. Keep that in mind when you are issuing shares in a company. If you are raising, now the department can ask you to prove not only the source of the shareholder from whereas he paid the money, but source of source. from where has the shareholder got his money? It's an unfair section. If the shareholder has got his money and he cannot prove it, go and charge him. You have the power in law to charge him. You have the power in law to charge him with concealment. You have the power in law to raid him. You have the power in law to do a variety of things. You can't really charge me on the basis of source of source. But fair or unfair, the section is there. So you have to accept it as a fact of life until somebody is able to challenge the constitutional validity of such a section and have it. But today the courts are extremely unwilling to interfere because some of the perception is there that there is a lot of misuse of things like this, and therefore any anti-avoidance rule, the courts would not like to interfere. So the possibility that you will get a court which will go on the pure technicality that such a rule is unfair and therefore hold it to be invalid is very low. It won't really happen because courts go by perception, they don't necessarily go by law. And by perception, it would go against you. And then if you are charged, it will be charged under 68. The effective tax, as you will see, is almost 88%. Because the penalty is also virtually automatic. So what you are really saying is almost the whole of the money is paid off in tax. It's a little better than the Black Money Act, because in Black Money Act, you would pay 120%. Here at least it's 88, you are left with 12% out of the 100 which you received a share. So that's the difference. You have to comply with FEMA if you are issuing to non-residents, make sure of that. Look at the percentages, the permissions, etc. And the key point which I would like to mention is that you now again have in FEMA one escape route. If the application is coming from an NRI or an OCI holder, or his company, his trust in which he is owning 100%. So you have an NRI or OCI person, and he is willing to make a non-repatriable investment in India. He is saying that I'm making this investment. I am not saying that I will take the money back. I don't want the right to take the money back or the profits back. Then it is deemed to be a domestic investment and FEMA does not apply. So you are outside FEMA for that investment. All the domestic investment rules will apply. So that's a very big route out. If there is foreign money which is willing to come in, it can come in as non-repatriable money. In today's world, non-repatriable means nothing. First, dividends are repatriable, even on a non-repatriable share. So dividends can go out because current income of a non-resident can go out. Second, if you have money in India, you put that money in a company as equity. That company can invest outside India 4 times its net worth. So therefore, as investment, it can again go out. So the money is non-repatriable. That company remains in India, the equity remains in India, but 4 times the net worth is again gone out and is invested outside. So repatriation is not so important in today's world. Repatriation not being so important, you have a bypass to FEMA. Here you don't have to worry about sectoral limits. You don't have to say that in telecom, I cannot have more than 49% shares or more than 74% shares. That in airlines, I can't have more than this. All those limits, etc., nothing applies because it is deemed to be as if an Indian is applying. It's taken on par with that. The reverse, when you are raising capital outside investment, you have a variety of limits by which you can invest outside your capital. We talked of 4 times the net worth, which you can do. The only limit there is if it crosses 1 billion, then you need to go to Reserve Bank for approval, even if you are within the 4 times net worth limit. But then you are talking about maybe 10 companies in the country which can afford to invest that type of money. So other than those 10, nobody else is impacted with this 1 billion limit. And you can set up JVs, WOSs, subsidiaries, etc. So a fair amount of freedom is available to act internationally. So capital can move both from abroad into India and from India outside. And it is moving. There are as much investments being made by Indians. India is amongst the largest external investors in UK today. It is not the Americans, it's not the Canadians. India is amongst the largest. So there are as many Indians investing outside India as there are those investing in India. So capital is moving on both sides, and all that you need to do is make sure that you are compliant with these rules. Your paperwork has to be perfect. You have, for example, in a slightly different context, but it's the same issue of FDI, you have the classic case of Flipkart, where the tribunal refused to give the exemption under the Mauritius Treaty. Not the tribunal, the advanced ruling authority refused on the ground. And if you look at the grounds, the ground was the paperwork was not proper. They said, looking at this paperwork, we are not really sure whether the company made the investment or the shareholder of the company was the man who made the investment on that day and later on put it into the company. And if it was made naturally by the shareholder of the company who then put it into the company, then he's not entitled to the benefit of the treaty because the shareholder is from Cayman Islands. So it was a question of the quality of paperwork. They said this resolution was passed, but it was shown to have been passed in 2005, but for the first time it was produced in 2016 and so on and so forth. So I think that what we are talking is both FDI and ODI, make sure of your compliance. That's one of the most essential things. And the other thing, I think the other important one in ODI is the round tripping. Make sure that when you invest outside, that company does not invest back into India and does not hold anything in India. That continues to be the ODI rule today. It is going to be amended. RBI has indicated that we are going to amend this and we are going to permit you to invest in a foreign company which invests back into India, so long as you can prove to us that it is not meant for tax avoidance. But it is something which RBI has announced as an intent. They have not notified. Unless they notify that today's law is you can't have such an investment if they have an investment back in India. So the same money can't go out and come back. But it's not just the same money. Very often we prove that this money which went out was used outside. And that company made profits and those profits were used to make investment in India. That company borrowed money outside India and invested in India. This is not Indian money. RBI does not accept that. They still treat it as round tripping and we may get into problems. Because unfortunately, it is not there in any rule. It's not there in any of the regulations. It's simply there in an FAQ. But then what RBI says in an FAQ is also law. And that's the basis on which you must go. The other point on capital raising is considerations can be in cash, they can be in kind. You can always pay for shares by giving a property. You can pay for shares by doing work, by service, by signing a non-compete agreement. So you could pay for shares in a variety of ways. And if you pay for them in kind, different tax consequences will follow. To the extent that what you have paid for in kind is transferred, there is a capital gain or a business income which you have earned, those may follow. But you can get shares in kind also. So that is the same true which happens in a slump sale, in a merger or demerger. Effectively, the company is issuing shares and getting a benefit in kind, not in cash. So issuance for kind is as much visible as for cash. Turning to the types of debt, again, you have a variety like shares, loans, deposits, debentures, and the borderline between them, because we are concerned with compliance. very, very difficult to actually identify. But take a section like Section 186 of the Companies Act. It applies to loans. It does not apply to deposits. Intercorporate deposits is one way of looking at it. Why? Because the 186 is replacing 372. Under 372, this question had arisen whether loan and deposit are equal. They introduced an explanation which was added in 372 to say that for the purpose of this section, a deposit is also a loan. So therefore that matter came to an end. Under the 13 Act, that explanation has not been continued. The restrictions of 372 continue, but the explanation has not been continued, which would mean that 372 doesn't, 186 does not apply to a deposit. It only applies to loans. Having said this, what is the distinction between a loan and a deposit? When do you say I have borrowed a loan and when do you say I have received a deposit? What is the real difference? And the real difference the Bombay High Court has given explained that in a loan, you have accepted conditions, so it is your obligation to repay on the due date. In a deposit, it is for him to ask for it, or things like that. But I can't see that difference making any real difference in practice. Whether I have to go to him and pay him, or he has to come to me to take the money back. There is no real difference. Both are effectively having the same relationship between the lender and the borrower, but you do have these. Take a debenture. What is the difference between a loan and a debenture? What is a debenture? A debenture is a mere acknowledgement of loan. That's how it is defined. I have taken a loan, I give you an acknowledgement, and that acknowledgement is converted into a transferable security, so it becomes a debenture. So I acknowledge that you have given me a loan of 1 lakh, but if I acknowledge that through a debenture, now you have a piece of paper or a demat right, which you can transfer. If I give you a simple receipt saying I have received the loan of 1 lakh, it's a simple receipt. That's the only difference. But otherwise, a debenture is a mere acknowledgement. So all of them are more or less same. You have a variety of instruments, but each one has some differences. Different laws apply. You have a whole series of sections applying to debentures. They don't apply to loans. So issuing it as a debenture, you will have altogether different compliance rules from issuing it as a loan. So they are almost identical twins, almost. They are slightly different twins or triplets or whatever you like, depending on the number of varieties of debt. But they have different terms and conditions attached to each one of them. And therefore, you will decide which one makes more sense for you. You have to consider between interest, interest-free, a deep discount bond, a premium on redemption. Different ways of giving yield. All of them are interest, except interest-free. And if it is interest-free, then clearly it stands on a different footing. But otherwise, what's a deep discount bond? A 100 rupee bond is sold to you for 60 with a promise that it will be redeemed at 100 after 5 years. That means 40 rupees is interest of 5 years. That's what it really means. And you have bought the bond for 60. Or I give it at 100 and say, I will redeem it at 160. Premium on redemption. It's the same thing. I'm going to pay you 60 rupees as interest on 100. So these are different ways, but you can, each one does make a slight difference in its tax and other implications. Interest is allowable, but allowable from year to year. You have one decision which has allowed the entire premium on redemption in the first year in which you borrowed. You have the Supreme Court which says the deep discount bond, the discount can be pro rata allowed over the life. Against the department arguing that in a deep discount bond, I will allow the discount as an expense only in the last year. Because it's only in the last year that you have to pay 100 for 60. Till then you don't have to pay. So I will not allow the 40 rupees as an expense. So different tax and other consequences will follow. They are otherwise the same. You decide which one works for you. Foreign borrowings versus local borrowings, INR, on demand versus fixed term. You make a loan on demand, a lot of rules will go away. Section 186 requires you to charge a minimum rate of interest on loans, corresponding to the rate of interest prevailing on government securities of a similar tenure, 1 year, 3 year, 5 year, 10 year, and so on. In an on-demand loan, you would say that there is no similar tenure, and therefore there is no fixed rate of interest, and therefore I don't need to charge a rate of interest in an on-demand loan. The on-demand loan may not be demanded for 1 year or 5 years. It's effectively become a 5-year loan, but it was an on-demand loan. And because it was on demand, you did not have to comply with the 186 condition, requiring you to pay a minimum rate of interest equivalent to the rate of interest prevailing on government securities. So you, as I said, again, variety differences, secured, unsecured, convertible, non-convertible, and so on. Company law has its own compliance issues. Section 7 in relation to primarily for issuance of debt. For taking of loans, section 180, for giving of loans, sections 186, and so on. Limits are there. You need to pass shareholders' resolutions in certain situations. Certain situations, you can do it on the board of directors and so on. If it is a related party, again, you would have to go elsewhere. And that decision which I spoke of, which distinguishes loan and deposit, is Durga Prasad Mandalia. Coming to the tax consequences, loans can also become dividend under 222E, depending on whom you are giving it to and whether you have reserves. In that case, it becomes a dividend. I mean, each of these sections alone we can discuss at depth, but then we are trying to, generally speaking, deal with the whole of capital issuance as a whole. The same section 68 issue, which we spoke of in relation to shares, source of source, has now been applied from this year to loans. Till this year, it was not applicable. From this year, it is applicable. And the worst part of it is, it equally applies to non-residents now. In the context of shares, the source of source rule is applicable only if the shareholder or the applicant is a resident. If a non-resident has bought your shares, you don't have to prove source of source. His source is enough. He's come through a bank and that is enough, and that is the source, and you are able to show that. And there is no other way he can come. Reserve Bank will not permit him to come unless he's come via bank. But therefore, there you don't have to, but in the loan you have to. So if the same man, the shareholder, has given you a loan, he can give an ECB. A shareholder is allowed to give you an ECB up to 7 times the amount which he has invested in shares. That's permitted ECB. So you can borrow. So you may work with your shareholder saying you invest $1 million and give me loans of 6 million. Because on 6 million, I will pay you interest, which is tax deductible. On 1 million, I will not get tax deductible interest. But that way, and you are allowed to give me a loan up to 7 million, and I can use that money for my business. So you could work out an arrangement like that. On the 1 million, you don't have to prove source of source. On the 6 million, you will have to prove source of source. Because that is now the new section, section 68. So in that case, if he cannot say from where he got the 6 million, which he is lending to you, it becomes your income. And then the same consequences, the 88%, which we spoke of earlier, would apply because it is section 68. In income tax, the same 56(2)(10) and 56(2)(7)(b type of issues, depending on the valuation of the debt, and the debenture and the loan, especially for convertible debentures and all, this can become material. But almost the same rules. On an interest-free loan, is it really without consideration? So is it a gift? And the answer is no. It is a gift of the interest component in substance. But 56(2)(10) does not charge the gift of the interest component. It would charge only the gift of the principal component. And the principal component is returnable. Because it is returnable, that is for valid consideration. Being for valid consideration, 56(2)(10) should not apply to an interest-free loan. Same thing would apply in a 0% CCD. But can you, for example, issue therefore a 0% CCD and say, I will convert on that day's value? Then effectively the man who's giving you the money, what is he getting? He's neither getting interest, nor is he getting the appreciation. I can have a 0% CCD and say, I will convert at par, at today's value. Then he's as good as buying equity. The only thing is, he's keeping it as debt. And he will get the equity in the future. That's the only difference. But if I say I will convert on that day's rate, frankly, I'm effectively issuing shares at a discount, possibly, or at an excessive premium, depending on the terms of conversion. Now, shares can't be issued at a discount, but is this backdoor available to issue shares at a discount? Can you issue them as CCDs and then do this? On the backdoor, also the question whether 7B applies. Because 7B talks of issuance of shares, the anti-avoidance rule which we spoke of, charging an excessive premium. You charge an excessive premium on convertible debentures, not on shares, and convert them in 6 months. Will that escape 56(2)(7)(b)? So in the example which we were giving, is it possible for somebody to say and come and say, all right, I will not buy your shares, I will buy your debentures. And then that debenture worth 1 lakh, you convert into 1 share of 100 rupees after 6 months. And I will agree to that condition. So effectively, I'll give you a premium of 99,900. Will that work? Will that loophole work? Subject to GAR? Yes. How GAR will look at it, I don't know. I would assume that GAR will catch such a thing any day. Coming to the new section 194R, if you give an interest-free deposit, interest-free loan, etc., is that a perquisite or benefit? And therefore, would you have to deduct tax at source on the implied interest? Because he is giving you a benefit. So does he have to deduct tax at source? You are not paying interest. That's your benefit. On that benefit, the person giving the benefit has to deduct tax at source. So not only is he giving the loan, he has to also deduct tax. On what does he compute and how does he do it? Is it really a perquisite or benefit? We'll have litigation which will answer this question. We do have that decision in Salgaonkar Brothers where the Supreme Court accepted it was not a perquisite or benefit, but I think it is a very peculiar on facts decision. And one of the key factors which weighed with the Supreme Court was that the finance bill that year specifically charged interest on an interest-free loan as a perquisite. And then next year, before that would actually apply, because it was effective from 1st April of the next year, before it actually became applicable, the Finance Act changed that and removed that condition. So they said the very fact that Parliament first said we will charge it as a perquisite and then removed it shows this is not a perquisite. So that's a very different way of looking at it. I'm not sure that would apply in today's context. So the possibility that it is a perquisite, yes. The possibility that it is hit by 194R, to my mind, no. I think 194R applies to perquisites or benefits given. Given must mean something passing from the giver to the person who's receiving it, implied benefit is not given. So I would be on the word given. I think one would still escape from 194R, but only next 5 years of litigation will tell us where the real answer is. And the way the board has interpreted 194R, the circular, based on that interpretation, the board would say this is chargeable. The board is effectively saying anything and everything is chargeable. They have said a discount is chargeable. And as a special concession, they have said, however, because it would create difficulty in practice, we are saying you don't need to deduct 194R on that. But they are saying it is a benefit. I'm saying a discount is not a benefit because it is not given. It's implied. So that is the difference. The board's view is therefore very clearly different. You have on capital account transactions. On transfers, as I said, I don't want to deal with them because I don't think we would have the time. The only issue which one has to consider is the TDS provisions, because we are concerned with compliance. So if you buy and sell unlisted shares, will there be 194Q? On listed shares, the board has given a circular saying what you deal in on the stock exchange, 194Q will not apply. But that's a concession. Now, because there is a concession for listed shares, by implication, 194Q is applicable to unlisted shares. It's applicable to shares. If they are listed, you fall under the circular. If they are unlisted, you must deduct. That's the view of the board. In practice, unless you can afford litigation, and anybody who's liable to deduct TDS can't afford litigation, for the simple reason, what are we talking about? 1%, 0.1% TDS. For that, the stakes involved can never justify litigation because the type of legal fees you will pay before you finally prove that it is not liable to TDS will far exceed any TDS you have paid or could possibly pay. So nobody can afford that. Nobody can litigate on it. You will deduct. So if you buy or sell unlisted shares worth 50 lakhs, you will have to deduct tax on that. If you buy and sell an undertaking, is it covered? Same issue. Is it goods? Is it not goods? The section uses the word goods. But what is goods? Every property is goods. So capital account transactions also would be covered, is one view. What is the argument for saying they are not covered? Which, as I said, you will not be able to press because of the practical difficulty of pressing it, the cost of pressing it. And the argument to my mind is only one. If you read the section as a whole, it applies to a person who is in business with a turnover threshold exceeding a certain turnover. If therefore you read the section, the goods referred to in that section must be goods in the course of business, goods in which you deal, goods which you buy and sell for business. It should not apply to other goods. It should not apply to unlisted shares. It should not apply to an undertaking which is not in the course of business. So that's the argument. But board circular being what it is, I would advise that you deduct rather than go by this argument. Now coming to the return of money, buyback is one route. You have the 1034A exemption. So as far as the shareholder is concerned, if the company does a buyback, he does not pay shares, pay tax. So effectively today, buyback is far more tax efficient way of returning money than a dividend. A significant shareholder who receives a large dividend or whose income otherwise is large will effectively pay almost 36% tax on dividend income, 35.9%. And no deduction because expenses are not deductible. Interest is deductible only to the extent of 20%. So effectively, almost the whole of it is taxable. If on the other hand, the company gives him the same money by buying back shares pro rata, if they are pro rata, you are not worse off or better off. You had 10% shares before that, you now have 10% shares after that. So there is no change there. In that type of situation, if he does a buyback, the effective rate of tax on the company is 23.9. And if you gross it up and work it back to what it really costs the shareholder, because company is paying that 23, you are not paying. It is 18.9%. So buyback is much cheaper than dividend. And that is what a number of listed companies are thinking of doing. But on the other hand, it's very clearly stated that buyback should not be a substitute for dividends under the Companies Act. So one would normally say, if you have been paying a dividend of 30%, you continue. But if you were going to make 30 into 40 this year because you have done better, that extra 10%, do it through a buyback, which is more tax efficient for some of your key shareholders. That's how companies are looking at it. Give a bonus redeemable preference share issue, then buy back those redeemable preference shares. A variety of structures are available. On buyback, there is one area which I think I would like to discuss, namely the 25% condition, section 68. It's, I think, misunderstood, because under the 1956 Act, the condition was different. So the point is, how much can a company buy back in a year of its equity shares? Can it buy back 90% of the equity shares? And only 10% effectively becomes 100. Can that be done? Now, one view of the matter is no, but section 68 says 25%. The language is the buyback is 25% or less of the aggregate of paid up capital and free reserves of the company. That's section 68 2C. So based on that language, and especially because of the proviso, which says the reference to 25% in this clause shall be construed with respect to its total paid up equity capital. People take the view that you cannot buy back more than 25% of the total paid up equity capital. I think the better view is you can buy back 90%. The amount you can pay for 90% is only 25% of the capital plus net worth. So naturally, the shareholders who hold 90% are losing. Because if they hold 90%, they are entitled to 90% of the net worth. If they agree to give it away for just say 1% of the value of the company, that buyback is possible. Effectively, it's a transfer from the 90% shareholder to the 10% shareholder, because the 10% shareholder has now become 100. That's what you have achieved. 56(2)(10 should not apply because the 10% shareholder has not received any shares. 56(2)(7)(b) should not apply. None of the existing anti-avoidance sections will apply. Will GAR apply? My view is no, because generally speaking, benefit, my share becoming 100 times its value, is not taxable. In the first place, it is not taxable, it's not income. If it is not income, then how can I avoid tax on that? I can avoid tax on something which in the first place is income, and then I do some structuring to avoid tax on that. Here is a case where it is not income. You have an artificial section which says that in some situations, 56(2)(10 will apply and it will be charged to income tax. If the artificial section doesn't apply, it doesn't apply. You can't apply GAR to the artificial section. You can apply GAR to natural income, to an item which is otherwise taxable as income. So GAR should not apply. So this buyback route is available. There is the tax on the company, that 23%, as we have said. One key issue is the company liable under 50CA? That you need to think through, but the better view is, or 56(2)(10, sorry. And the better view is no, because 56(2)(10 applies to purchase of a capital asset, and the company is buying a share which it is cancelling within 7 days. It cannot be called a capital asset. A capital asset you buy to keep, buy to hold for interest, for dividend, for yield, for appreciation. You don't buy something which is to be cancelled the next day. So that's not a capital asset, therefore 56 should not apply to it. An inflated buyback would of course be dividend, deemed dividend according to the courts. And on redemption of preference shares, Supreme Court has taken the view in Anarkali Sarabhai that even redemption of preference shares is a purchase and a sale. So though we are using the word redemption, it's a purchase sale. So the buyback rule should apply to a redemption of preference shares as much as it applies to normal buybacks. So that is one area where you would have to pay the 23% tax and not go by 222 and those rules and try to take the position that redemption of preference shares is not chargeable, or at the most is chargeable to dividend in the hands of the shareholder. I would say the company is liable if it pays more in redeeming preference shares than what it got as face value. We have talked of GAR and the consequences. Buyback therefore clearly has the advantages which we have talked of. In FEMA, it is as good as a purchase and sale, and therefore the purchase and sale rules of the Reserve Bank need to be complied with. The other way of returning capital in a sense is capital reduction. If you do a Section 230 scheme, Section 68 has to be complied with for buyback. But for capital reduction, Section 68 does not have to be complied because it falls under Section 66, not under 68. So you can have capital reduction which exceeds all those percentages. None of those limits apply. You only go through the process. Special resolution, meetings, approval of NCLT, meetings of creditors and so on. But subject to that, capital reduction is a way which works. You can have targeted capital reduction. Reduction of only one class of shareholders. In a company where promoters are 90%, only the 10% minority is reduced. So you are really squeezing out the minority. That's what you're doing. You are canceling their shares. They have to vote, but 75% votes are with the person who has got 90% shares. So even if they vote against, it will still pass. So the resolutions will all go through. You will still be able to do it. The only thing is they can go to the tribunal and object. The tribunal will, in line all probability, look at the reasonableness of what is being paid. They will not stop the cancellation. Because the cancellation is a right of the company and of the shareholders. The way the section is drafted, they will only stop if they feel that 1,000 rupee share is being bought back for 100 rupees. So then the tribunal will interfere, not otherwise. There is only one tribunal decision, NCLT, which is against, where they rejected. All others have allowed such a buyback, targeted buyback. So effectively, you can do a minority squeeze out. You can comply with FEMA. Income tax, it would be there would be dividend 222D to the extent reduction is out of profits or you have reserves. The rest of it is a capital gain in the hands of the shareholder. The other, on capital account transactions, one other issue is loan waivers. A lot of SIC companies are getting a lot of waivers. In IBC, you have a lot of waivers. Waivers are becoming a way of life today, where you either don't pay the full loan or you pay only a part of it. You get a haircut of 30, 40, 60, 80%. It all depends. So to what extent would these capital account transactions get liable in tax? And you have directly, luckily, my Supreme Court in Mahindra and Mahindra saying it is not taxable under 41(1), it is not taxable under 28(4). So those are, I mean, Supreme Court being there, you don't have to apply your mind as to whether it's right or wrong, it is right. The logic is irrelevant. If the Supreme Court has said it, that's the law, till the law is amended by an amendment. Mahindra was a case of loans from capital account for buying machinery. So the question is, does it apply to working capital loans? Does it apply to overdrafts? Does it apply to trading liabilities? And a number of people feel that if it's a trading liability, 41(1) would still apply. And some high courts had said that. But after Mahindra, you have a decision, which again was a whole group of decisions which went to the Supreme Court. One of them was this Compact Electric, where it was a trading liability. Supreme Court treated the whole group of 10, 20, or I don't know what many cases And in one line said on merits allowed, following Mahindra. But they said on merits. So since Supreme Court has said on merits, it's final. That means even for a trading liability, compact is the law. It cannot be charged either under 41(1) or 28(4). The only risk is Mahindra was naturally at a point when there was no 56(2)(10). So therefore, the Supreme Court has not examined 56(2)(10) because it related to that year when the section didn't exist. Would that apply? That's what one has to think of in waivers now. The only one, is that a benefit in the hands of the borrower? Now, normally one would argue that for 56(2)(10) to apply, there must be a receipt of cash or of property. In a waiver, there is neither a receipt of cash or of property. Therefore, it should not apply. But the argument may not succeed. Because the argument of 28(4), which the Supreme Court has applied in Mahindra, is that a loan waiver is equivalent to a receipt of cash. Now, if Supreme Court says it is as good as a receipt of cash or not as good as, they say it's a receipt of cash, and therefore 28(4) does not apply, then you can't say that for 28(4) it's a receipt of cash. For 56(2)(10), it is not a receipt of cash. It's a very difficult thing to argue, but one can try. Even then, whether that will work, again, time will tell. Waiver of interest, that will be covered by 41(1), subject to the point whether you have claimed a deduction in the past or not claimed a deduction. I think the rest of the issues, deductibility of interest, dividend, etc., and DTAs, are more routine, more normal, and therefore I would stop here because I think we have exhausted the time available to us. Thank you very much for having heard me so patiently.
I believe that this is the kind of session where we got all the answer of our questions automatically during the presentation. So let's have a big round of applause for Gautam sir. Sir is always helpful to WIRC to have any kind of program with him. I recognize the presence of CA Gautam Lat, Regional Council member. Now may I invite CA Vijender Jain to propose well-deserved vote of thanks for such a wonderful session.
Very good evening and all. I thanks on behalf of WIRC for giving me the opportunity to offer the vote of thanks. Such a wonderful, honorable past chairman, today's speaker, none other than CA Gautam Doshi, sir. Please give the great round of applause. Sir, everyone knows you covered the care and compliance undertaking the capital transaction. You covered each and every topic in the detail, and you give the very fabulous example, practical example on the round tripling, source of rule, and TDS on capital transactions. Sir, as we aware, you covered each and every topic like 56(2)(7), 56(2)(10), buyback of income, buyback in terms of company law. And lastly, you covered the Mahindra and Mahindra capital example and this case laws. I also congratulate a regional council, entire team in chairmanship of Murtuza Bhai, and wonderful MOC done by Saurabh Ajmera and Gautam Lat. Please give the great round of applause. And thanks all the members who are coming there and joining the virtual session. Thank you. Thank you so much.
Thank you, Vijender Bhai. Now may I request each one of you, please join for a tea break of 15 minutes at first floor. Thank you very much, guys.
So taking this forward, direct tax is always a worry because it is going from out of a person's pocket, and we always plan to do different kind of structures, different kind of, we try to or intend to find different type of loopholes and different type of structuring which are legally allowed. Partnership and LLPs always been a structure since ages, and there are still there are certain issues which we generally face while drafting a partnership or forming a LLP. It is very important, or it is a critical to know what are tax implications and how to mitigate any kind of tax risk, if we are saying how to mitigate that. So now I request CA Saurabh Azmera to kindly introduce our today's speaker. Okay. Before that, I'm sorry. So I request CA Priti Savla ma'am to please address the session. Ma'am, please.
Thank you, Gautam. Dear Saurabh and Gautam, both regional council members, CA Vishal Gada, the faculty for the session, all seniors, participants present over here and watching online. A very good afternoon to all of you and welcome to this session after this snacks. And hope all of you are enjoying this DTRC. We always used to have DTRC either at Birla Matushri or Yogi Sabhagra, 2 to 6 on June month, all Saturdays. But however, after and last two DTRCs were online only. And after this pandemic, we thought ki at least we should start physically and also on hybrid mode. And that's why, so actually before the session, Vishal Bhai was telling me ki where is the auditorium. I was coordinating with him ki I have come for the first time to the auditorium and it's very nice auditorium. So I told Vishal Bhai, in 9 years, I was in WIRC, last 9 years before becoming Central Council member. And you always been invited to DTRC, what I recollect. And then DTRC and various other programs which are organized by WIRC only, but those programs are always big programs and always at the venue which has more than 1,000 members participants. So that's why you have not seen this venue. And now also we have more than 1,000 participants, but it is on hybrid mode. And that is what about Vishal Bhai I can say. Whenever any topic relating to direct tax comes and we have a large conference, the first name comes to our mind is CA Vishal Gada. And thank you, friends. And he is so down to earth, having such a specialized knowledge, and in spite of his busy schedule, he has always been available for the institute, for the WIRC. So once again, welcome to this DTRC 22, CA Vishal Gada. And as regards to the institute, recently we had a council meeting on 29th and 30th June, and lot of things have been deliberated. We have also made one group, and group has also come out with their suggestions on a lot of things are happening. We are looking in the newspapers about interrogation and other departments like ED, CBIs are coming to the chartered accountants, calling them and asking various things. So one group has been formed. That group has already given their findings in the council meeting, and we are going to the legal for vetting, and that policy will be coming out, which all other authorities will have to be followed. It has to be followed by all the other authorities. So let us see what best we can do for our members. Again, I have been appointed as a vice chairperson of Sustainability Reporting Standard Board and Corporate Laws and Corporate Governance Committee, Women Members Empowerment Committee. And at Sustainability board, we have already given drafted a social audit framework and draft social audit standards depending on this SDG 17 social development goals, and given it to SEBI. SEBI has also given their comments and will be finalizing and giving, and that will be mandatory. So this will be applicable for the CSR also. And again, we don't know, but it has been announced by the finance minister about social stock exchange. Let's see when it will be coming. So this all NGOs and all can be listed on the social stock exchange. So see, these are certain developments, and we are regularly interacting with SEBI. And as regards to Ministry of Corporate Affairs, Corporate Laws Committee, we are in touch because recently all of you are aware that LLP version 3 forms have come, and various difficulties have been faced by the members for filing the forms, formation of LLP and all. But we are regularly in touch with Ministry of Corporate Affairs. Our own people are also there sorting out the issues of the members for filing this V3 forms. Again, the institute MCA is coming up with V3 forms for companies also, and 11 such forms will be initiated in the month of August if they are going, and those tests are being made by our own people at Ministry of Corporate Affairs, and this entire things are run by L&T. So these are the broad things which are happening on in the front of for the committees in which I have been assigned the portfolio. Again, as regards to direct tax, the direct tax committee has already come up with draft tax audit guidance note, and that will be outreach program. For that we will be doing it now in Mumbai also, as discussed with Chairman DTC, and then we will finalize and approve. It will get approved in the next council meeting, which will be required to be followed by all the members for tax audit. Again, there were certain issues relating to the UDIN also, that also we have tried to sort it out from the CBDT. So these are the broad things which are happening at the ICAI level. And we have already with us Vishal Bhai. I don't want to scratch his time also much. So friends, thank you very much for listening me patiently. And once again, I compliment WIRC and entire team for organizing this DTRC, for disseminating the knowledge. Thank you very much.
Thank you, Mishra ji. Thank you so much, Preeti ma'am, for letting us know so many initiatives of ICI. Friends, I'm sure all of you are hearing sustainability and about sustainability standard, and there are so many things which institute is doing, on the sustainability front. And all credit goes to Preeti ma'am. She is working day and night, to create sustainability standard and to have, some kind of sustainability. Sustainability standard and sustainability reporting, so we can work towards a sustainable nation building. With this, I would request CS Saurabh Azmera to kindly introduce our today's faculty.
It's indeed great honor and a privilege to introduce our well-known speaker, Vishal Gada sir. He's a founder and mentor of Autos Consultancy. He has over 20 years of experience in advising clients on tax and regulatory domain. Prior to founding Autos Consultancy, he was partner at KPMG and also one of the founders of Dhruva Advisor. He has also featured in the list of top tax professional in India in the survey conducted by International Tax Review. He is a qualified chartered accountant and has completed the business consultancy studies course conducted by Jamnalal Bajaj Institute of Management Studies jointly with Bombay Chartered Accountants Society. He also holds a Bachelor of Law degree. He has worked on numerous complex M&A transaction, corporate recognition and regulatory issues. He has co-authorized a couple of books on professional subject and regular speaker on various professional forums. So let's have a big round of applause to welcome our new speaker, Vishal Gada sir. Thank you.
Yeah, thank you, Preeti Ben, Saurabh, Gautam, and my professional colleagues. I think what we'll do for the next 75 minutes, we'll touch upon certain tax aspects of partnership firms, LLPs, and I'll be talking about the partnership firms and LLPs in unison because really from an income tax perspective, both are treated as absolutely the same, taxpayer entity. The way I think we'll go about it is that very quickly I'll touch upon the basics of the firm stroke LLP. We'll talk a bit about the new provisions which have come in from last year on the reconstitution of the firm LLP, which I think actually is the only complicated part in the whole LLP taxation framework. We'll also talk a bit about conversion of company into LLP. If a company wishes to convert into an LLP, what are the conditions, what are the intricacies, what are the issues? We'll then talk reverse. If a firm wishes to convert into a company again, what are the conditions? A bit about restructuring of LLP, certain case studies we'll pick it up. And maybe we'll touch upon two case studies in the context of foreign partnerships, time permitting. Very quickly, as I mentioned, the important point is that while from a legal perspective, a partnership firm is governed under the Partnership Act 1932, and the LLP is a separate incorporated body under the LLP Act. From an income tax law perspective, both are treated as one and the same, and they both are commonly referred to as the firm. From a legal perspective, a partnership firm is not a legal entity. It is actually, a couple of partners coming together and joining for a common purpose where they are sharing profits. Whereas an LLP has some kind of an infinite existence because it is an incorporated body. So irrespective of what happens to the partners, the LLP in its legal form continues. That is, I would say, one of the most fundamental difference between these two entities. And the second fundamental difference is that in a partnership firm, one partner represents the other. One partner is, I would say, an ambassador of the other partners. Whereas in an LLP, that is not so. A partner in an LLP does not represent the other partner. That is one of the key features as to why people prefer LLP more than a partnership firm. This is to ring fence the liability because one partner cannot make the other partner, held responsible for some of his actions. And in any case, the statute under the LLP gives a limited liability cover to the LLP vehicle. But as I mentioned, from a pure tax perspective, it is irrelevant because both are treated as one and the same entity. Very quickly touching upon the tax rates, if the taxable income is 1 crore or less than 1 crore, then the taxable rate is around 31.20%. And if the taxable income exceeds 1 crore, then you obviously are at almost 34.95%. There is no double taxation because once the partnership firm or an LLP pays the tax, any share of profit which is withdrawn is obviously exempt. This is one of the distinguishing feature of a partnership firm versus a company. And many times while a company has a lower tax rate, let's say it opts for a 115BAA regime where it pays around 25% tax, any withdrawal of dividend obviously is taxed at a significantly higher rate in the hands of the shareholders. Very quickly touching upon the allowability of partners' remuneration and interest on partner's capital. It's commonplace that a partner's remuneration paid by the partnership firm or an LLP is tax deductible. Correspondingly, it is taxable in the hands of the partners. There are certain conditions which needs to be taken into consideration. One is it has to be in accordance with the partnership deed or the LLP agreement. So if your LLP agreement or a partnership deed does not have a mention of the relevant partnership remuneration, then such a payment is not a tax deductible. Second is it should relate to the period post the date of the execution of the LLP agreement. So if a new partner has been admitted, obviously you can't give him partner's remuneration prior to his admission per se. So it's a very logical provision what they have brought in. There are certain quantitative restrictions. There are certain quantitative limits as to what quantum of partnership remuneration is tax deductible. It's up to 3 lakh of your book profit. Book profit is computed in a very normal way. There's a formula given. You add the partner's remuneration, come up with a book profit number. It says up to 3 lakhs, you can pay 90% of your book profit or 1.5 lakhs, whichever is higher. That's a deductible sum. And anything above that on the balance book profit, 60% of the book profits can be paid as partner's remuneration. If you paid anything above this, that portion is not deductible. Consecutively, that portion is also not taxable in the hands of the partner. So in any case, I don't envisage any double taxation. And also one fundamental principle is that from a tax perspective, it's only a working partner who can be paid a tax deductible partner's remuneration. If somebody is a sleeping partner, the partnership deed mentions that this partner is a sleeping partner, etc. You obviously cannot pay him any tax deductible partner's remuneration. Similarly, if you come to interest on the partner's capital, the rate is capped at 12%. That's the first restriction. Second is that it should be mentioned that so and so interest is payable. If your agreement is silent about it, you cannot make a payment of partner's capital, which is then claimed as tax deductible. And also, it should be relating to the relevant partner or its representative capacity. All these conditions apply to that. Let me give an example. Let us say a trust is a partner. A trustee which is representing the trust is earning that relevant interest on capital. All these conditions, including the cap of 12%, applies. But moment that trustee, which was representing the trust as a partner, in his individual capacity, gives a loan or puts in any funds, these provisions, this cap of 12% doesn't apply per se. So really all these provisions are relevant for the partners and not for people who are not partners. Some interesting controversies which have happened is that under the chapter relating to business income, you have this section 36(1) Roman 3, which says that interest payable is deductible only if it is for the purposes of business. A controversy has happened. There was a partnership firm. It borrowed money. The money was borrowed actually to pay back certain retiring partner. It was not actually utilized in the business. The partnership firm claimed that I am deducting that interest in accordance with section 40B, which has those limits, caps of 12%, etc. I do not need to really get into a separate section 36. Courts have generally held it is not so. You have to satisfy, the conditions which are outlined under section 36. So it has to be necessarily demonstrated that whatever partner's capital has been deployed on which you are paying interest and you are claiming a deduction is actually deployed for the purposes of the business. So the end use of a partner's capital becomes very, very important if one needs to, claim it as a deduction per se. In other words, what section 40 clause B does, it caps the deductibility, but 40 clause B does not create a deductibility provision. That deductibility is really under section 36, which needs to be complied with. The second controversy which has erupted, in some sense, 40B is what we call some kind of a rigor on the overall deductibility. We also have another section, 40 capital A, which says that certain expenditures which happen between related parties, they have to be not excessive. They have to be at arm's length. It's like a quasi-transfer pricing provision built in since 1961. Can the tax officer come back to say that, yes, the interest paid, the remuneration paid is within the caps given under section 40 small b. However, I would still like to verify the accessibility of this payment under 40 capital A. Does he have the right to do that? And apparently the courts have taken no. These two provisions talk about restrictions on the overall deductibility. 40 clause B is a specific provision for the partnership firms and for the partners. And therefore, once you fulfill the caps which are provided under 40 clause B, you don't have to go to 40 capital A per se, which I think is a welcome provision. As you are aware, you also have alternate minimum tax, which is in some form, a MAT, which is levied on the company. Similarly, we have an alternate minimum tax, which is levied on the partnership firm. This is levied only on certain incomes, which are claimed as deductions under Chapter 6A. Will not get into the details of it. You can carry forward your MAT credit or AMT credit, what you have paid, for a period of 15 years. And obviously, you can claim that as a credit on a year-to-year basis, provided you are paying the minimum normal tax liability per se. So the provisions are very, very similar in terms of what the MAT provisions for Companies Act are. There are certain tax benefits which are there to an LLP. For example, from a company's perspective, any distribution, any loan paid, to the shareholders, you will always verify the rigors of deemed dividend, which is there under section 2, subsection 22. If there's a private company, there are reserves and a loan is given to that concerned shareholder, it is treated as a taxable dividend. However, no such provisions exist in an LLP. And therefore, if an LLP were to give any loan, interest-free loan, etc., to its partners, there are no provisions which will hold those payments as taxable. So to that extent, the rigors of such distribution are far less in an LLP compared to a company. Similarly, there are certain provisions under section 2, subsection 24, where a benefit given to a substantial shareholder is treated as a taxable event. There is no such provision under the LLP. So if an LLP is providing any benefit, there are no provisions similar to section 2, subsection 24, which will hold those benefits as taxable. And let me give an example. I am a shareholder in a company. I hold around 10% plus, so I qualify as a substantial shareholder. The company has a guest house and the company is allowing me as a substantial shareholder to use that guest house. That's a taxable item. I may not be an employee. It might not be a perquisite taxation, but because I'm a substantial shareholder, section 2, subsection 24 is still wide enough to cover that benefit as a taxable benefit in the hands of the shareholder. But if instead of that company, it was an LLP had some kind of a guest house or some kind of a residential flat, which it is allowing some of its partners to occupy, there are no provisions which would tax such kind of a benefit. You also have at the same time certain tax limitations. So a company could have received those benefits, but because that taxpayer is structured as a partnership firm or as an LLP, it is not able to do it. For instance, 35(2)(ab), which obviously has now touched its sunset period, always used to refer to companies. It's a company which will get benefit under 35(2)(ab) in terms of its R&D expenditure. A partnership firm, LLP, was not able to take that as a benefit. Similarly, there are a lot of tax neutral provisions for companies. You merge two companies, you demerge companies, all these provisions or all these restructurings can be created in a non-tax manner. But what if you merge two LLPs? Can you say that this merger of two LLP is not a taxable event? There are no express provisions for that. We'll obviously touch upon certain case studies, but there are therefore certain benefits which a company has, which a partnership firm or an LLP is not really inclined to. And look at one of the key benefits. A couple of years back, government introduced this 115 BAB for new manufacturing companies. You create a new manufacturing company, you are eligible for a 15% corporate tax rate for eternity, but you have to be a company. If you're a partnership firm, you are an LLP, and you are now creating a new manufacturing unit, sorry, you are not qualified. So again, there are certain provisions which are expressly applicable only to a company, not to an LLP. I think touching upon the, I would say, broad basics of an LLP, what we'll do, we'll go into certain modules. The first module which I want to touch upon is this whole reconstitution of the firm or an LLP. What is a reconstitution of a firm or an LLP? I think first let's touch upon it. If a partner retires or you add new partners, or there is a change in the profit sharing ratio of the existing partners, one of these three events will constitute reconstitution of a partnership firm or an LLP. Moment there is a reconstitution of a partnership firm or an LLP, I think we need to be very, very careful, and we need to evaluate whether this is creating a taxable event for the concerned partnership firm or an LLP. What the government has done a couple of years back, they've introduced section 9 capital B, and they have completely revamped section 45 subsection 4. These are one of the most complex provisions, as you know, the ensuing case studies would demonstrate. And that has, in my view, created a lot of hardships, lot of complexities whenever you do any reconstitution. And let me give a very simple example. Let's say there's a chartered accountancy firm. It's there for the last 50 years. There is now a partner who has retired, and obviously he will take his goodwill once he's retiring. This is a taxable event as per the new provisions. As simple as that. For the last 100 years, right from the 1922 Act to, I would say, 2020, such events of a retiring partner taking excess amount was never considered as a taxable event, but it is no longer so under the new provisions. And we'll probably go step by step. The irony is that there could be twin taxability on certain reconstitutions. There could be a taxability under section 9 capital B, and there could be an additional taxability under section 45 subsection 4. This is where I would say the complexity is getting compounded per se. Very quickly, what I want to do it is that give a comparison of these two sections, section 9B and section 45.4. So the first red flag is one has to look for a reconstitution. Moment there is a reconstitution, one has to look for implications under section 9B and implications under section 45.4. And both sections could apply parallel. You could actually pay taxes under both the sections. It is not necessary that only one of them can apply. What is the trigger of taxability? From a section 9B perspective, the trigger of taxability is either a dissolution or a reconstitution. Whereas from a section 45 subsection 4 perspective, the trigger is a mere reconstitution. So if you are dissolving the firm, you don't have to look at 45.4, you merely have to look at 9B. But if you're reconstituting the firm, you have to look at both the sections. The second is, what is the subject matter of distribution which gets covered under one of these two sections? If you are distributing a capital asset or a stock in trade to the retiring partner or to an existing partner, section 9B gets triggered. But if you are distributing cash or a capital asset to the partner, then section 45.4 gets triggered. Which means if you're distributing a stock in trade to a partner, you only have one section which is applicable, which is section 9 capital B. If you're distributing cash, which is the most common ways, let's say, of giving it to a retiring partner, then only one section gets triggered, which is section 45.4. But if you're distributing a capital asset, then obviously both the sections apply in tandem, and which actually creates a double taxation, as we would see in one of the case studies. Who needs to pay this tax? While the benefit is given to the partners in both cases, the tax is to be paid by the concerned partnership firm or LLP. This distribution, this receipt is exempt in the hands of the partners, but it is the partnership firm or the LLP which pays the taxes on behalf of such partners. What is the year of taxability? Yes, in the year in which you distribute this, that's the year of taxability. And what is the characterization of such income? Now, in case of section 45.4, it is treated as a capital gain. And in case of section 9B, if you are distributing stock in trade, it is treated as a business income. And if you're distributing a capital asset, it is treated as a capital gain. Again, it depends on what are you distributing per se. And how do you determine that concerned benefit, business income or capital gain? If you're distributing a stock in trade, the market value of that stock in trade is regarded as a taxable business income. If you're distributing the capital asset, again, the market value of that capital asset is regarded as taxable income. This is from a section 9B perspective. So that's how you will determine the taxable amount. So let us say, I have dissolved my firm. When I have dissolved my firm, I had certain stock in trade. I have distributed to the partners, and I had certain capital asset. I have distributed to the partners. The market value of these assets would be regarded as a taxable item, but in the hands of the firm which has dissolved. Similarly, if I have distributed a capital asset, which is now also covered under section 45(4), there's a separate formula. It says that the value of the money you pay plus the fair market value of the capital asset on the date of receipt is the starting point. Less the capital account credit, you reduce it, and the balance is actually considered as a taxable event. What we will do it is, I'll actually take certain case studies because this will be more apparent in a case study. And why don't I do that? And maybe we'll come back to theory. So let's say there are three partners. There is a LLP called ABC LLP. All the three partners have equal partnership interest. Everybody is holding 1/3 profit sharing ratio. There's a balance sheet given in the case study. The capital account credit today is 10 rupee each in the hands of each of the partners. And there is a corresponding land parcels. There are three plots of land parcel X, Y, and Z. They've also been bought at 10 rupee, but the market value is different. We have indicated the market value in the balance sheet. The market value of X and Y is 70 rupee. The market value of Z is 50 rupee. Now, A wishes to retire from the firm. And what it has been agreed is that we will make a payment of rupees 11 as cash to A, and we will distribute one capital asset, which is land parcel Z, whose fair market value is 50 to A. This is really, so there is first of all a reconstitution happening because one partner is retiring. On reconstitution, you are paying cash and you are paying capital asset. As we discussed, moment you pay cash, only section 45(4) comes into effect. Section 9B doesn't come into effect. And if you pay stock in trade, only section 9 capital B comes into effect, but there is no stock in trade being paid. So you don't have to worry about section 9B in the current case study. And if you pay capital asset or distribute capital asset, then both the sections apply parallelly. So in our case, because I'm distributing the land parcel Z, I have to look at section 9B also, and I have to thereafter look at section 45(4) also. And let's look at how these two sections apply when this concerned partner is retiring. So first, let's look at section 9B, and let's look at the first table. The market value is 50 rupee. The index cost of that land is 15. The cost was 10 rupee as you looked into the balance sheet, and let's say we do some indexation, it's 15 rupee. So the long-term capital gains which are chargeable in the hands of the firm under section 9B is 35 rupee. On 35 rupee, let us say we have paid a long-term capital gains tax of 7 rupee. So the net benefit is 28. But under section 9 capital B, the firm is paying a capital gains tax of 7 rupee. So this is the first implications under section 9B. This is very simple. 9B is very simple. The complication is actually 45(4). Now, when you have so-called transferred your land at rupees 50, there is an adjustment required under the capital account to reflect this transaction. And what is that adjustment? Let's look at it from an accounting perspective. The sale consideration was 50 from an accounting perspective. And why do I say the sale consideration was 50? Because you are effectively transferring the land to the retiring partner. So in the books of account, you will treat it as a so-called distribution at 50 rupee. The cost of the land was 10 rupee. So from an accounting perspective, the profits earned by the firm is 40 rupee. Now you have already paid, or you are going to pay a tax of 7 under 9 capital B, as we discussed above. So you reduce this 7 from 40. So 33 is the net accounting profit which has arisen in the books of the LLP. This 33 rupee you divide between three partners today. And when you divide between the three partners, the capital account of 10 rupee, which is there in the name of each of the partner, will get converted to 21, 10 plus 11, 21. So you have, after computing the taxes under 9B, you have recomputed your capital account. And now in your capital account, your amount is not 10, but your amount is 21, including the capital account of the retiring partner, which is A. Having computed the revised capital account credit, we now go to compute the taxes under 45.4. So let's go to 45.4. Under 45.4, what are we paying to the retiring partner? We are paying a cash of 11 rupee and we are paying an asset worth 50 rupee. So you are actually paying 61 rupee to the retiring partner. What is the credit in his capital account? The credit in his capital account is 21, the readjusted credit, what we have worked out. So what is the net benefit which the retiring partner is taking? The net benefit which the retiring partner is taking is 40 rupee. This 40 rupee is a taxable item in the hands of the firm under 45.4. So it's interesting. You have already computed a capital gain under 9 capital B, and now you have computed the second capital gain under section 45.4. And somebody would say, you know, I don't want to do all this, you know, what's the best way to come out of 9B and 45.4? And the best way to come out of 9B and 45.4 is B and C simply buying the LLP interest from A directly and making a payment directly. That's the best way. If there is any purchase of partnership interest or LLP interest outside the LLP between the partners, that transaction does not get covered under 9 capital B and 45.4. So after the introduction of these sections, we are actually seeing more and more such outside the balance sheet transactions where a partner who retires, his share is actually taken over by the balance 2 partners rather than the partnership firm paying an excess amount, which is actually creating a taxable event per se. But we'll leave it for some other case study. Now let's get into the real complexity of 45.4. We have computed that the capital gain under 45.4 payable by the firm is 40 rupee. And the way we compute it is cash plus the value of the land minus the revised capital account credit of 21. Now look at what happens to this 40 rupee as capital gain. And this is where I would say the complexity increases substantially. This 40 rupee needs to be allocated to the surviving capital assets. Now, what are the surviving capital assets in the firm? The surviving capital asset is the plot of the balance 2 land. Land parcel Z is being given away. What is left? Land parcel X is left and land parcel Y is left. So this 40 rupee, which we have paid, needs to be allocated to the 2 land. And I'll come to it why you need to allocate to that 2 land under the rules. The cost of these 2 land was 10 rupee. The FMV is 70 and 70. The increase in value is 60 and 60. So we should focus on the column about increase in value, which is 60 and 60. The increase in value is absolutely identical between the 2 remaining capital asset. Now this 40 rupee, you distribute between the surviving capital asset in the ratio of increase in value. And because both of that is 50-50%, you will attach 20 rupee to land parcel X and you will attach 20 rupee to land parcel Y. And because land parcel X and land parcel Y both are long-term capital asset, you will offer this 40 rupee to long-term capital gain. What if land parcel X was a short-term capital asset and land parcel Y was a long-term capital asset? In that case, outside the 40, you would have paid 20 rupee as short-term capital gain under 45.4 and the balance 20 as a long-term capital gain under 45.4. It's amazing. You don't have to look at the outgoing asset to determine whether this 40 rupee is a long-term asset or it's a short-term asset. To the surviving capital assets to which you attribute this value, your characterization of 45.4 will depend, which is, it perplexes me absolutely as to why so much of complexity has been created. What is the purpose of earmarking this 20 rupee to land parcel X and earmarking another 20 rupee to land parcel Y? This earmarking is, I would say, of good benefit. The law says that in future, when you sell X, let's say for 100 rupee, your cost is not 10 rupee. Your cost is 10 plus 20, 30 rupee. So in a way, whatever amount on which you have paid capital gain today under 45(4), we will give you a deemed credit in the form of a cost escalation in future, so that the tax which has been paid by the firm under 45(4) will be recouped in future as and when you sell the land. But what if I do not sell land parcel X and land parcel Y? Then this 40 rupee under 45(4) becomes my permanent tax cost. This is in substance what 45(4) is, and what I'll do for the sake of simplicity, let me take 5 minutes and redo this case study, because if you have understood this case study, you have understood 9B and 45(4). Let's go back again. A partnership firm, 3 partners, ABC, 1/3 each. Today the capital account says 10 rupee, 10 rupee, 10 rupee. There is a corresponding land parcel X, Y, and Z, 10, 10, 10 rupee, the original cost. The market value is 70 rupee, 70 rupee, and 60 rupee. Mr. A says, too much of work, I am retiring. The other partner says, no problem, we will pay you rupees 11 and we will give you a land parcel on your retirement. Now, because you are giving him cash of 11, you only need to look at 45(4). 9B doesn't come into play. Because there is no stock in trade distributed, 9B is irrelevant vis-a-vis the stock in trade. But because you are giving a capital asset, both 9B and 45(4) comes into play. First, we'll compute the tax under 9B. Computation of 9B tax is very simple. 50 rupees deemed as the sale consideration. Index cost is 15 rupee. Original accounting cost was 10 rupee, and let's presume the index cost is slightly higher. So your capital gain is 35 rupee. The firm has to pay the tax, not the retiring partner. The firm has to pay a tax of 7 rupee. Let's say 20% is a long-term capital gain. Having computed the tax under 9 capital B, you go back and readjust your capital accounts. How would you readjust your capital account? Look at accounting profit. 50 rupee sale consideration, 10 rupee cost of land, 40 rupee accounting profit, 7 rupee tax paid under 9 capital B, balance is 33. Divide this 33 as a credit in the books of the 3 partners. So each of the partners get an enhanced credit of 11 rupee. Now the new capital account is not 10 rupee, it is 21 rupee. Once you compute the new capital account, which is 21, now you go ahead and do the complicated working under 45 subsection 4. How do you compute your quantum of taxability under 45(4)? What is being paid? 11 rupees being paid, an asset of 50 rupees being paid. So what you are doing is you are paying 61. What is the current credit in the capital account? 21. 61 minus 21, 40 rupee is the taxable amount under 45(4). Now you have computed the taxable amount. Is this 40 rupee to be offered as a long-term capital gain or as a short-term capital gain? It depends on your surviving capital asset, because this 40 rupee, you will attribute it to the surviving capital asset in terms of their future cost escalations. When we looked into land parcel X and land parcel Y, both of them were long-term capital asset. So clearly this 40 rupee which you have computed under 45(4) will be offered to tax as a long-term capital gains. Now for the purpose of future cost escalation, how would you divide? Look at the increase in market value today. The increase in market value for both the surviving capital asset is 60 rupee each. So you allocate 40 in the ratio of increase in market value. So 50% of 40, 20 is added to parcel X, 50% of 40 is added to parcel Y. When would this addition of 20 benefit the firm? When they finally sell in future. When the firm will sell in future, you will further reduce this 20 rupee as an additional cost when you are computing the capital gain. So in essence, one day, if the partnership firm or this LLP sells this land parcel X and Y, whatever taxes they have paid on this 40 today, on the partners retiring, will one day be effectively be recouped, right? But if you sell it, if you do not sell it, it's a permanent cost. Now, what's a way out to come out of all this? If the partners are smart, they will tell Mr. A, see, we need to pay you effectively 61 rupee. there's already a credit of 10 rupee lying in your books. First, the firm will pay you 10 rupee, no taxability, because you're not getting anything enhanced. I now have to pay you an additional 51 rupee. Both B and C will pay 25.50 rupee and buy the share. Moment you do such a transaction outside the partnership firm or outside the LLP, there is no implication under section 9 capital B. There is no implication under section 45(4). That's probably, in my view, the only way where you avoid the rigors of this complicated double taxation under these two provisions per se. Right? So I just thought, let's take a case study rather than doing a theory around it. Let's take one more case study while there are 3 to 4 case studies, and then maybe we'll move to the second module. You again have a partnership firm, ABC LLP, again, equal profit sharing ratio. The total partners capital is 4 lakhs each. 4 lakh by A, 4 lakh by B, 4 lakh by C. What they have done with that capital, they have invested into listed shares. So the only capital asset which is there is basically listed shares. The cost of those listed shares is 12 lakhs, obviously, but the market value has doubled, which is now 24 lakh. Again, Mr. A wishes to retire, and it has been decided that because you are retiring, we will pay 2 things to you. We will pay your 4 rupee, which is the capital account credit, and we will pay an additional 4 lakh, which is the 1/3 share in the value appreciation of this listed stock. Because 12 lakhs have turned to 24 lakhs. The profit or potential profit of 12 lakhs belongs to all 3. Again, what are the tax implications of an LLP? Now, let's look at section 9B, as simple as that. You will first compute the tax under 9B because there is a capital asset being distributed. The value of that capital asset is 4 lakh. The cost of that corresponding is 2 lakhs. So the firm will pay a capital tax on that balance 2 lakh under 9B. Then you will readjust your capital account, because there is a accounting profit happening. After readjusting your capital account, you will go and then compute your overall tax under 45(4). You will basically say that I'm paying you 4 plus 4, 8 rupee. What is there in your capital account is actually 4 plus some small escalation, which could be, let's say, 66, 4.66. The balance is a long-term capital gain. You will allocate that balance long-term capital gain to your current listed stocks. That is your overall taxability under 45(4), but there is a cost escalation which has gone to the listed stock, which means that whatever tax you have paid on 45(4), one day you will recoup it when you sell your listed stock. Here there is only one catch. The capital gains tax payable by the partnership firm or this LLP is at a higher rate compared to the capital gains tax which they will pay on the listed stock, which is at 10% plus surcharge. In this case, while quantitatively they will recoup whatever they have paid as additional capital gain, from a tax rate perspective, they will always be at a loss. This is another example, but we are following the same principles. Again, what's the best way to come out of all this? Pay Mr. A 4 lakh. Don't distribute any capital asset. Let B and C buy the stake of Mr. A for 2 lakhs each. And when they do that, no implications under 9B, no implications under 45(4). You don't have to get into this complicated computation and then characterizing it as a long-term capital gain and then earmarking it against the surviving capital asset. This is how, unfortunately, the provisions have become as complicated. I would say it's the most complicated provisions today, even compared to the company taxation. With this, what we'll do is, I'll not take other case studies due to paucity of time. We'll move into certain issues which are there under this section 9B, etc. For example, 9 capital B says market value of the capital asset. The question is that, can I take the jantri value, the stamp duty value of the land which we were distributing in our case study 1? Apparently seems it's not possible. You have to demonstrate that this is my market value. Your jantri value could be lower. In the absence of data, you might take a jantri value, you might take a stamp duty reckoner value, but ideally you have to otherwise say that this is the price at which deals are happening for that concerned capital asset. So that's the first problem you have in determining the FMV. The second problem is that whatever capital gain we have paid under 45 subsection 4, as we discussed, it gets attributed to the surviving capital asset. And while it gets attributed to the surviving capital asset, for the purposes of a future cost escalation, as and when they are sold, so that we pay lesser capital gains in future, there is no additional depreciation available today. So there is no question of any depreciation on any attribution which you do under 45(4). I think that's important. The third problem is that what if you do not sell individual capital assets? What if one day you sell your whole business? Can you still use this capital gain which you have attributed to that concerned surviving capital asset? There's an ambiguity. The provisions are silent. So tax office could say, wait a minute, if you would have sold your land parcel X or Y, I would have given you an additional cost escalation of 20 rupee. However, you have sold your whole business, and this business as a whole is different from a single capital asset. So whether this 20 rupee escalation can be added as a cost escalation, section 50B, under which you will compute your slump sale, is absolutely silent. So I'm not going to give you that benefit. So that's one more anomaly in that. And there could be, as I said, many anomalies. One can write an encyclopedia on, how 9B 45(4) will be absolutely, a black hole per se. So I think this is going to be a very challenging provisions to apply, to understand, and obviously to have clean assessments in the times to come. Let me now go to the second module, which is conversion of company into LLP. As we discussed, many companies believe that this additional dividend tax, this additional compliances under the Companies Act is a bit headache, and let's try and convert into an LLP. Is it so simple? Let's see. First, a very quick comparison between a company and LLP, and I'll just take some specific module. One big advantage of an LLP is a lower compliance. The compliances under the Companies Act are far more compared to an compliance under an LLP. The second is the CSR tax. You need to pay or you need to spend a mandatory 2% of your net profit if it exceeds a threshold under the Companies Act towards CSR, but you don't need to do anything of that sort in an LLP. Again, if there are related party transactions, you have an application of section 186 under the Companies Act, 188 under the Companies Act, 180 under the Companies Act. There are so many sections, where you need the support of minority shareholders. There are no such provisions under the Limited Liability Act. You do have an NBFC exposure if you have an asset and an income which exceeds 50% criteria. In an LLP, technically, the NBFC laws do not apply. NBFC law is enshrined under section 45I of the RBI Act. That section cannot cover anybody other than a company. Many years there was a working group set up to evaluate whether we can cover an LLP under the NBFC laws. Till now, there has been no legislation. So technically, an RBI cannot write to an LLP saying that you are an NBFC, come and register before me. There are some practical problems. The practical problem is RBI apparently has encouraged MCA to discourage LLPs which are purely into investment activities. Sometimes MCA or via ROC has issued notices that, hey, you are only doing investment activities. Whether those notices are valid, invalid, we don't need to discuss that today. But technically, the NBFC exposure is far reduced in an LLP compared to a company. So many families says that, why do I need to carry out investment under an company setup where I need to register before an NBFC, and why not an LLP per se? At the same time, there are certain disadvantages. FDI is subject to certain conditions. Obviously, if you're in the automatic sector without any sector-linked conditions, an LLP in a company is absolutely at par, does not matter. You are a technology sector, you are in the manufacturing sector, you are in the services sector, LLP is absolutely fine, as simple as getting an FDI in a company. But let's say you're into a real estate sector. Sorry, you cannot have an LLP which is into real estate where you get an FDI. A company would be possible. So obviously, if you are attempting to get an FDI into a sector which has certain sector-linked conditions, conversion of a company into an LLP is not advisable. Again, ECB, if you wish to avail foreign funding under the external commercial borrowing route, only a company can do it, and LLP cannot do it. So these are some some pluses and minuses. Most of the time, the pluses of being an LLP far outweigh than that of being a company. I would believe you will continue as a company only if you intend to get a private equity investor or an external commercial borrowing, or you intend to list in future. Other than these 2-3 conditions, you will see that a LLP structure, most of the cases, would always be far beneficial. I think having discussed the pluses and minuses of company versus LLP, let us look at certain tax advantages of getting into a LLP. And I think the key tax advantage of getting into an LLP is cash upstreaming. I pay a 25% tax in a company, but moment I try to extract the profits by way of a dividend, my taxability could be almost 37-38% additionally. And if I add both the taxes, my total tax cost of operating under a company actually could exceed 50%, as distinct from an LLP where I might pay a final tax of 34.92, let's round it off, 35%, and then I can extract that profit and there are no other taxes. So where your intention is to keep on extracting profits on a regular basis, a company model is one of the most inefficient model because it taxes you twice. One, when you make profits, second, when you extract profits. As distinct from LLP, where it taxes at a slightly higher rate, which is 35, but that's the final tax, and beyond that, you don't have to pay any taxes. I think this is one of the most important benefit of an LLP, especially if the shareholders are Indian shareholders, where a dividend tax is considerably higher at 37 to 38%. Let's look at the conditions which the income tax law has kind of prescribed if you want to convert a company into an LLP. It says that if you are converting a company into an LLP, then these are some 6 conditions which you better follow under 47 Roman 13b. First, all the assets, all the liabilities of the company should become that of an LLP. Absolutely simple condition to follow. Second, all the shareholders of the LLP should become partners. All the shareholders of the company should become partners in that LLP, and their profit sharing ratio should exactly be the same as their shareholding is there in the company. Again, achievable subject to certain nuance, which we'll take up in one of the case study. What if I have a combination of equity and preference shareholder? How do I satisfy this condition? And what's the practical view being taken? But we'll touch upon it. Third, once I convert my company into a LLP, then it says that the aggregate of profit sharing ratio of these existing shareholders which have become partners cannot drop beyond 50% for the next 5 years, which would mean that you have to constantly track that these old partners taken together should always hold a profit sharing ratio of 50%. You cannot admit new partners in such a way that this falls below 50% for the next 5 years. That's the third condition. The fourth condition, which in my view in practice is one of the most difficult to follow, it says that if you are a company intending to convert into an LLP, then in the preceding 3 years, your total turnover cannot exceed 60 lakhs and your total value of assets cannot be more than 5 crore. There is a academic debate on whether this value means market value or book value. For a variety of reasons, I believe that book value is the correct terminology. And I think there have not been many controversies around it. So you can take a view that this 5 crore is actually the book value. You don't have to really consider the market value. But look at the first condition. Total sales cannot exceed 60 lakhs. And the currency is also Indian rupee. It's not 60 lakh dollars. Which means even a panwala might sometimes not satisfy, converting his company into an LLP. And this is where, in my view, I would say, literally, you would see most of the companies being ineligible to convert itself into an LLP. And we'll come to it. How do people defeat that condition? We'll come to it in a moment. The fifth condition is no other consideration should be payable other than giving a profit share ratio and a capital contribution in that LLP, which again is absolutely possible to satisfy. And the last condition, no amount is paid to the partners of the LLP directly or indirectly out of the accumulated profits of the company as on the date of the conversion. So let's say you are converting the company today. The reserves are 50 lakh rupee. These 50 lakh rupee cannot be distributed to the partners for a period of 3 years. This is simple to obviate. So what generally people do is they would issue bonus shares of these accumulated reserves prior to conversion. When you issue bonus shares, your accumulated profit actually is then nil or negligible. And thereafter you will convert into an LLP, and your argument, technically correct, would be that when I converted on that date, my accumulated reserves were zero because everything was capitalized. And therefore, there is no restriction on what I distribute because I'll use this condition and follow it literally. The interesting condition is this 3 years condition, which is sales or turnover. There is a very famous Ahmedabad tribunal decision in the case of Urmin Marketing. It represents what everybody used to do for the last 6 to 7 years. I have a company with 1,000 crore turnover. I'll merge my company into a small company which satisfies this 60 lakh turnover criteria for the preceding 3 years and the 5 crore criteria for the preceding 3 years. After having merged the elephant into a dog, as one of my ex-senior used to say, I'll convert that dog into an LLP and I would say, yes, I'm satisfying 4713B. Pre-GAR, absolutely defendable, done multiple times. I would say there are hundreds of such transactions where a very large elephant used to be merged into a dog or an ant, whatever you want to call it, and converted into an LLP. Challenge is post-GAR. Is it defendable under GAR? And that's an issue for another day. There are a lot of transactions now happening where people are saying that, do I at all need the support of 4713B to convert it into a tax neutral manner? I need the support of 47 if outrightly a conversion is regarded as a transfer. If it's a transfer, it's taxable under section 45. But if it is not a transfer in its inherent form, why do I need the crutches of section 4713B? For example, you had a Bombay High Court decision of taxpin, where in the old days, a partnership firm got converted into a company. It never satisfied the prescribed conditions of tax neutrality, which is required for a conversion of a firm into a company. It argued before the court that, wait a minute, I will go to 47 if at all there is a chargeability under section 45. If prima facie, and why prima facie? If inherently a conversion is nothing but the same entity in a reconstituted form, how is there a transfer? If a partnership firm is converting to a company, all the assets, all the liabilities are vesting into that company. Is it like A transferring something to B, or it is the same A which has changed its cap of being a firm into a company? And obviously that argument appealed to the High Court, and it said, yes, a conversion outrightly is not creating any transfer. So where is the question of you satisfying any conditions of exemption under section 47? That Bombay High Court decision obviously has been followed in many, many other High Court decisions. The question is, can you borrow the same argument that a company converting to an LLP basically is the same entity? It's like I transferring something from my left hand to the right hand. How can that be a taxable transfer? Isn't it that I remain the same legal entity while technically my PAN, my GST number changes because of procedure? But isn't it that there is no third party involved? And for a transfer, you require two parties. At no stage of the process, you ever had two separate legal entities existing. And I would believe that's a very, very strong argument. It would obviously take a Supreme Court finally to create a closement on this and bless this kind of a conversion. But unfortunately, there are at least two negative decisions on LLP to company. First is a negative decision of Mumbai Tribunal Celestri, something I've quoted that in the presentation, where the tribunal said that, wait a minute, a firm converting into a company is different compared to an LLP converting into a company converting into an LLP. And how is it different? They said that under the Companies Act, there was no word called transfer. The conversion sections said that whenever a firm converts into a company, the assets and liabilities are auto-vested into a company. Under the LLP Act, the wordings are whenever a company converts into an LLP, the Act says that the assets and liabilities are transferred and vested in an LLP. And because the word transfer is there, we are deeming it to be a transfer. I humbly disagree with that rationale. But on that rationale, they said that a conversion of a company into an LLP is a taxable event, and you better therefore satisfy the conditions of section 47. But interestingly, they said that, however, in spite of the fact that a company has been converted into an LLP, there is no taxability because the conversion has happened at the book value. Whatever value was stated in the books of the company, the same values have been reflected into the books of the LLP. And therefore, 5 rupee recorded here, transferred at 5 rupee, 5 rupees minus 5 rupee is 0. They said there are no capital gains tax which is computable, and therefore there is no taxability. I also humbly disagree with this. If there is a transfer, sorry, you can't compare 5:5. You have to look at the market value, but that's perfectly fine. So while it inherently said that a conversion is taxable, right? It said that because of the fact that the values are recorded at the same value as its original cost, there is no question of a capital gains taxability. Very, very amusing rationale given by the Mumbai Tribunal. You also had this AAR. What is that decision? I am forgetting. Maybe I'll come to it again. I think some domino printing or something. There is a AAR ruling. AAR ruling again said the same thing, that a conversion is a taxable event. It did not give any rationale as to why it's not following the Bombay High Court of tax fin. It says the facts are different. That's it, nothing more. But it went on to say that, however, you can't argue that the book value being recorded at the same book value is appropriate and no capital gains is taxable. It went on to say that now you look at the market value of the LLP interest, compare it with your original cost in the LLP, and that difference is your capital gain. So, it actually took the computation to its logical end. These are the two reported cases where they have distinctly disagreed. My personal view is that a conversion inherently is not a taxable transfer because it's the same entity which is reconstituting itself. Hopefully one day we'll have a Supreme Court decision, putting an end to all this controversy. Till then, it is always a debate. How do I satisfy the conditions of 47(13)(b)? Should I take the legal view saying that a conversion is outrightly not taxable, so I don't have to worry about this turnover criteria, I don't have to worry about this asset criteria? Or do I do this elephant end theory, merging an elephant into an end, saying that I'll manage the GAR, in some manner, because GAR also gets triggered above a 3 crore benefit. So if you create an elephant end theory in such a way where your yearly benefit is not exceeding 3 crore, then technically there is no application of GAR by the tax offices. So there have been some transactions where people have done the elephant end theory in a quantitative manner where the GAR thresholds are managed. In my view, if a GAR cannot be applied, then a company merging into a small company and then reconverting into an LLP, there are no provisions which can stop its tax neutrality per se. So these are some interesting provisions in the context of tax neutral conversion of company into LLP. What I'll do, I'll avoid some of the theory and I'll very quickly touch upon some case studies since we just have some 20 minutes left. So let's look at ABC Private Limited. There are 3 shareholders, A holding 40% equity, B holding 60% equity, and C, which is holding preference shares, the balance preference shares. And the first question is that when I convert a company into an LLP, do I also need to make the preference shareholder the partner? Or can I say that this condition of making all the shareholders partners in the LLP only applies to equity shareholders? The way the section is worded, it's very clear. All shareholders, be it equity, be it preference, they have to be made partners in the LLP. So you cannot not make the preference shareholder as a partner. The second question, how do I look at the profit sharing ratio? Like, do I just look at what has been invested by A, B, and C? For example, A has invested 40 lakhs, B has invested 60 lakhs, and C has invested 1 crore, but into preference shares. Or do I look at just A and B, and I can allot any share to C, which is the preference shareholder? If you take a view, which I believe is the better view, that no, you also have to make C a shareholder, then you have to go as per the quantum of share capital. There are arguments against that, but a better view seems to be look at the quantum of share capital. So in our current case, you will have C, who's a preference shareholder holding 50% PSR. You will have B holding 20% PSR, and you will have, B holding 30% PSR, and you will have A holding 20% PSR. 40 lakhs, 60 lakhs, 1 crore, and you will have to issue them a profit sharing ratio in the LLP accordingly. After having issued this, can I change the PSR in the coming years or in the coming months? There is no restriction of change in PSR. You can change the PSR to reflect the true commercial understanding. However, the total PSR of these three people taken together cannot go below 50% for the next 5 years. So in a preference share, it is possible to, in my view, apply 47(13)(b). You have to, also make preference shareholder a partner, and you also have to look at its total shareholding in order to compute the PSR on the date of conversion. Moment you satisfy everything on the date of conversion, what you do next week, what you do next month, or what you do next year in terms of the change in PSR is nobody's, I would say, business. Let's look at another case study. You have an Indian company completely owned by Singapore company, like 99%. And they had invested in this company in the year 2015. And you have 1% being held by an Indian resident. This is into a manufacturing business. The turnover is 75 crore, far, far more than the threshold of 60 lakhs. The value of the total assets is 125 crore, again, far more than the threshold of 5 crore of asset. And then I'm converting this company into an LLP. And what Singapore company is contending that, yes, maybe I may fail on the argument that a conversion inherently is tax neutral. I don't need the support of 13B. I don't need to satisfy the conditions of 47(13)(b). But under the treaty between India and Singapore, this is not a taxable event. And I would believe, yes, under the treaty, it could say that even if somebody says that I've surrendered my shares, transferred my shares, and I've received LLP interest, because this is a capital asset, a share held prior to 1st April 2017, post which the treaty got amended, this capital asset is clearly grandfathered, and the Singapore company should be able to take a view that I'm not really worried about section 47(13)(b), because the treaty itself gives me a protection from any capital gains happening on transfer of my shares. Very quickly, third case study. I think we have discussed this, that we have issued the bonus shares. This is a case study to defeat the condition that the accumulated profits on the date of conversion I cannot distribute for 3 years. But if obviously I've converted those accumulated profits into bonus shares, then the condition cannot apply, because on the date of conversion, there are no reserves available per se. So let me avoid that. And this is that elephant end theory. I merge a large company into a small company, and thereafter I convert into an LLP. Done multiple times. You have a judicial precedent, and it's only the GAR issue. How would you plan towards a general anti-avoidance regulation? That's the only issue. And if you're able to plan it in such a way that your annual tax benefit is below 3 crore and there is no application of GAR, this could be one of the implementable manners in which you convert a company into an LLP person. Okay, let me very quickly go to the third module, sorry. This was the domino printing, which I was referring to, Celetry. Okay. Now let's look at a different thing. Let's look at a conversion of a partnership firm or an LLP into a company. So let's say you have a very large LLP. It says, I want to go for a listing, or I want to get a private equity investor. And obviously you cannot list if you're an LLP. And no private equity investor would normally come if you're an LLP. They would always want a corporate structure. So this is the reverse way what you are doing. Same thing, you have the conditions under 47(13). Under 47(13), you have a couple of conditions. The first is all assets, all liabilities of the LLP, it should be of the company, absolutely possible to achieve. Second condition, all the partners become shareholders in the same proportion as their capital account. So if let's say their capital account is equal, each of them get 33% of shares, equity shares. Again, I would say very, very simple to follow. The partners do not get any other consideration, any other benefit other than these shares. Absolutely possible. And the fourth is the aggregate shareholding should at least be 50% for a period of 5 years, which means even if they go for a listing, they should ensure that they do not divest beyond 50%. Let the public hold 50, but these three taken together will have to hold at least 50%. This is prima facie a more simpler condition to satisfy compared to a company into LLP. And LLP into company is far more simple. Imagine they would have put here only a LLP with 60 lakh turnover, 5 crore, blah, 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 can convert into a company. You would face the same issues here per se. There is only one catch in 4713, and thank God it has never come up in practice. If you look at a company getting converted into a LLP, the section says that I will exempt any capital gains arising on the transfer of the capital asset by the company to the LLP. And I will also exempt the shareholders whose shares are being extinguished and an LLP interest is being created. It covers these two items of exemption. The problem in the drafting of 4713 is it only says that whenever a partnership firm is getting converted into a company, any capital asset going from the partnership firm to a company is exempt. It is not talking about the extinguishment of the partnership interest, which gets extinguished against which you receive the shares. So the top level exemption is not available. And the amusing part is we have never seen any tax office till date objecting to this. So we have not seen any publicly reported controversies around it, but can a very, very sharp tax officer come back to say, wait a minute, I'm obviously giving you the capital gains exemption of whatever capital assets have been shifted from the firm into a company, but the partners are exposed because the partners have extinguished their partnership interest and they have received equity shares, and there is no apparent exemption for that step. It remains. So I think it's more of a drafting error. I do not think that's the intention of the law, because if you look at the memorandum, etc., the whole conversion exercise was supposed to be tax neutral. I'm pretty confident if it erupts, maybe CBDT will come up with a benevolent circular saying that, no, sorry, this is not the intention. Don't touch the partners who are satisfying the conditions of 4713. There are arguments to say that even if you want to tax my extinguishment of the partnership interest into a company, right, then you'll have to determine the cost. And candidly, there is no cost of a partnership interest or an LLP interest. A partnership interest or an LLP interest is a matter of contract. It is not a matter of capital. Unlike an equity share where you put 5 lakh, 50 lakh and you receive corresponding shares, a partnership interest, a LLP interest can be created without putting a single rupee into the credit account. So your partner's capital account credit has nothing to do with your partnership interest of 50% or 80%. So there are also some strong legal arguments that whenever a partnership interest or an LLP interest is sold, how would you compute the cost? Because candidly, I've never paid for it. I've just signed a contract to get this interest per se. And hence you will definitely apply the Supreme Court decision of BC Srinivas City to say that capital gains mechanism fails completely. I think it's a very, very strong view in this case. Okay, let's take some case studies before we move on to the balance 1 or 2 modules, and then we can have some quick questions. So you have again 3 partners holding 20%, 10% and 70% into ABC partnership firm. The total partnership contribution is 10 lakh. We are now converting the company into, we are now converting the partnership firm into a company. And what the company is going to do is they are going to issue equity shares to A, equity shares to B, and preference shares to C, which is interesting. And the question is whether issuance of preference share would impact the tax neutrality of the firm. The technical answer is no, because the manner in which it is worded, they are saying that you become shareholding in the same capital proportion in which you are. So you have an ability to issue a combination of equity shares and preference shares when you are converting from a partnership firm to a company. There are better ways to do it. Why to issue this? Rather you issue a OCRPS, let few people convert that OCRPS into equity, let the balance convert that OCRPS into a preference share. So optically, there are better ways to do it, where at the conversion point, you issue the same class of shares, but one gets into equity, another gets into preference share at a later point of time. But assuming you have done a combination of equity or preference, but in the right proportion, I think you will be satisfying 47-13. I don't think we will be violating that. Let's take case study 2. You have XYZ who are partners in XYZ partnership firm, and we want to convert it into a company. And we have issued the shares in the relevant capital contribution. Then post conversion, Mr. Z has transferred 25% stake to X and a new investor, which is A. And what is the tax neutral, whether the tax neutral conversion is impacted? If you look at the revised shareholding, Z now holds 20%, a new shareholder holds 25%, and X has increased. But collectively, X, Y, and Z hold at least 50%. And because they are holding 50%, the conditions of section 4713 are not violated, which means you can have inter-se transfer. You can even get in a new investor. The care should be taken that for 5 years, X, Y, and Z retain 50% of the total shareholding. Another case study, you have PQR. They are again partners in the partnership firm. And we are converting this into blah, blah, blah. And PQR is issuing shares to P, Q, and R in the ratio of 50, 25, 25. Ideally, it should have been 25, 25, 50. So what has happened is, on the date of conversion, it has not satisfied the conditions of issuing the shares in the same proportion as their profit sharing and capital contribution ratio is. The question is it something which is tax neutral? No, it is not tax neutral from a 4713 perspective. One may still argue on the first principles that a conversion itself is not taxable. But if one were to say that, has it satisfied the conditions of 4713? Doesn't seem to be. And then obviously you have a whole barrage of taxability in the hands of the partnership firm and in the hands of the partners. But the recipient, which is a company, technically there is no taxability because it is only receiving and issuing something. It's the partners which might be held to be extinguishing their partnership interest into company shares. I think you can argue the cost is incomputable, and it is the LLP or that partnership firm which might be held that it is transferring the asset, and in turn there is a consideration being paid to the partners of that person. Okay, so let me very quickly touch upon this merger of LLPs. There are no provisions of tax neutral merger of two LLPs. The LLP Act permits it, but the tax law does not recognize it, which would mean that if you are merging two LLPs, or if you are even merging an LLP into a company, which now of course is not possible as per the new NCLAT decision, it used to be possible in the old Companies Act. Under the Income Tax Act, you do have an exposure that this restructuring would not be regarded as a tax neutral restructuring. You will only be left to argue on first principles that when A has merged into B, effectively it has kind of surrendered all its assets, liabilities into B, and there is no existence and there cannot be a taxability. But I think this argument is not as strong as A converting into a company, because there it was always a single party. In a merger, there are two parties involved at a point of time. So to argue that there is no transfer, etc., is going to be, in my view, a Herculean task. So clearly, any merger, demerger of an LLP is fraught with very, very high tax exposures because of no such provision supporting its tax neutrality, unlike a company per se. We spoke a bit about this transfer of stake in the LLP, and in my opinion, the only way to obviate Section 9 capital V, the only way to obviate Section 45 subsection 4 is to ensure that the partnership firm does not give anything beyond what is there in the capital account, but it's really the surviving partner which makes the payment to the retiring partner. That's the only way. At the same time, you can argue, like the retiring partner who is selling his partnership stake to the surviving partners can argue that this is not a capital gains tax event because the cost of my partnership interest cannot be computed. You will clearly apply the principles of Supreme Court in BC Srinivas Shetty per se. I think lastly, I'll just take two case studies in the context of foreign partnerships. and then possibly we'll conclude on today's sessions and have some Q&A. Look at this diagram. You have an Indian company. Indian company has held in a US partnership. Sorry, it's the reverse. I'm so sorry. You have Mr. A and Mr. B, which are partners in a US partnership firm. And Mr. A is a tax resident. Mr. B is not a tax resident of US. It's a tax resident of some other entity. And there is a transaction which is happening between the US partnership firm and an Indian company, whereby the Indian company is, let's say, making certain interest payment. The Indian company wants to evaluate that if I am making the interest payment, do I withhold taxes on this interest under the domestic tax law, or should I apply the concessional withholding tax rate under the treaty? To apply the latter, which means to apply a concessional tax rate under the treaty, the US partnership firm should be regarded as a tax resident of US under the India-US treaty. One of the principal condition of a foreign entity being regarded as a tax resident, that it should be liable to tax in its home country. The problem in US is that a partnership firm, unlike India, is not regarded as a taxable entity. It is regarded as a pass-through entity. So a partnership firm or an LLC is never an entity liable to tax in its home country. So prima facie, the US partnership firm fails the first primary test. There is an exception in the India-US treaty, which says that if a US entity is not liable to tax, then the treaty will apply to the extent its partners are liable to tax. In this case, you have a set of partner who is liable to tax in US, which is Mr. A, 70%, and you have a set of partner, which is Mr. B, who's not liable to tax in US. So in such cases, what happens is whenever an Indian company makes a payment to the foreign partnership, it will apply the treaty rates to 70% of the payment, and it will apply the domestic tax rates to 30% of the payment. Now, this is a very, very theoretical answer. And the reason it's a theoretical answer is, and this happens many times whenever we engage US law firms and we make payments to them. So we say that you want treaty benefits, you'll have to tell us the share of profit of your US partners versus your non-US partners. And they say that even the partners do not know what is the share between themselves. You know, why would we disclose to a third party? So you will never get this public information from them, and they will say, forget it, you just deduct under the domestic tax law. We are never going to say what is the share of profit of US versus non-US. So this is a problem we face many times when we make payment to foreign law firms, which are structured as partners, which are not, as I said, taxable entities. However, if somebody is cooperating and somebody says that I'll give you a certificate that 70% of my partners are in US, then your payments can be splitted in two manners: 70 subject to treaty benefits, 30 which are non-US partner related, not subject to treaty benefits, on which you will apply the domestic tax rates. Let's take the last case study. Same concept, but this partnership is not a partnership in US, it's a partnership in Netherlands. Now the exception which is available in the India-US treaty, which says that, okay, if the partnership is not liable to tax, look one level up. Look at their partners, whether they are liable to tax, and if they are liable to tax, you apply the treaty benefit. This exception is not available in most of the treaties, including the European treaties, including India-Netherlands treaty. So in this case, even though both the partners, A and B, might be resident of Netherlands, because the partnership firm in Netherlands is not subject to tax treaty, whenever India deals with such a partnership, it will deduct taxes at the domestic tax rates and not at the concessional tax rates which are there in the India-Netherlands treaty. And therefore, to that extent, dealing with a fiscally transparent foreign partnership has always been a challenging case in the context of withholding taxes whenever payments are made. So I think with this, what we have done is we have covered the foreign tax module also. I think we are almost shooting up time. If there are any questions, very quickly we can take up, or we can wind up this session per se. Yes. Yeah, if there are any, or we just close it. Yes. Yes.
Shareholder, what would be the argument?
So for the shareholder, the argument would be that there is no consideration received by them. So the way we argue for a firm to a partnership that my cost is not computable, you cannot argue that for a company because your cost in the shares is computable. However, what you receive is a partnership interest. So there the argument we make is that this partnership interest is not towards consideration of the surrender of my shares. This partnership interest is towards a contract which I have signed. So there you argue it a bit differently, saying that there is no consideration involved. Now, whether you succeed in that argument, Almighty knows, but that's legally a good
If I
argument.
apply to 50 CA, then over there,
50 C.
CA.
Okay, it cannot be because there is no consideration involved.
Okay.
There is a debate on 50D. Can you apply 50D? Because in a 50D, what happens is where the consideration is not determinable, right? Then you apply the market value of what has been surrendered. So let's say a tax office says that you are saying that the consideration is not determinable because the partnership interest is a matter of contract or whatever it is. Then I will apply 50D and I will look at the market value of the shares surrendered. But there the essential condition is that there has to be a consideration, though it is not determinable. Your argument is that there is no consideration. You can't say that I've got this partnership interest merely because my shares are surrendered, because the basic reason why I've got it is by way of a contract. Yeah. Now, as I said, it's a technical argument. Only somebody who likes technical things, would accept it. So we'll have to wait for a court to hold it. Yes, sir.
Says that it has to be transferred, and there is not a transfer. Now, my question is that 47 itself starts with this heading that transactions not regarded as transfer, number one. So why it is not a transfer? It is only because of Bombay High Court.
I agree with you.
Number one. Number
Right.
two, if the capital goods is converted into stock in trade, that is a transfer. Why? But the transaction is deferred for the purpose of the taxation, but it is transfer. So why cannot be argued by the tax officer that it is a transfer? I will treat this as a transfer, and maybe that we may be caught at some time.
Right. No, you are right. And see, the fundamental debate is the fact that there is an attempt by the legislature to create conditions to say that so-and-so should not be regarded as a transfer. Implicitly means that it's a transfer, or at least the legislature means it's a transfer. But the courts believe, no, it's not so. So you can actually say that 4713B could be OTOs, right? It's not required at all because you have to satisfy the primary thing about 45. And on a lighter note, I'll just share a joke. It's about, if you go to a church and you tell a pope, can I smoke while I'm praying? He'll say, no, you can't smoke. But if you say, can I pray while I'm smoking? He says, yes, you can pray. So it all depends on, how you are arguing before a court that, is the primary important or the secondary is there, and hence you presume there is a element of primary per se. See, there have been so many sections which says that if it is not implementable, it is not implementable. And I would think that the essential condition of 45 is a transfer. If you satisfy 45, you go to 47 for a relief. If you do not satisfy, I would say the conditions of 45, prima facie, I believe a better view is you don't have to go one step forward. It's like, I don't have to really worry about an exemption per se. So I think courts take that view generally. I don't think in assessments, tax officers are very, very, happy to take this view per se. So I still believe that while there is a section which says that I'm giving you an exemption, it still merits a debate as to whether that exemption is at all required or not. So they should have actually made an amendment under 45 saying that a conversion is deemed to be a transfer. The way they have made an amendment saying that a capital asset to a stock in trade is deemed to be a transfer. So I think it's a bit of a drafting error under 45. Yeah.
One last question.
In a reconstitution 54 EC. Okay. I may be slightly not updated on that, sir. My assumption was that 54 EC doesn't cover a firm, but maybe I'll check it once again. But you're saying a firm is entitled to exemption. And if assuming the firm is there in 54 EC, why not? It should get it per se. Yes. Here Hemant is sitting who files my tax returns. Hemant, I don't know, is 54 EC covered? Firm. He's confirming a firm is covered, you know. So, okay. Then sir, it should be available per se. Yeah, why not? Okay.
I recently came across someone gave me a tax advice that a company which has a piece of land and it has turnover exceeding 60 lakhs. So it wanted to avoid both the conditions of 5 crores and 60 lakhs. So the advice was that you demerge that land into a separate company and convert it into an LLP, subject to GAR getting no problem with GAR, as well as the demerger being tax neutral. And since that is the demerged company is a new company, for preceding 3 years, there is no 60 lakhs, no 5 crores. So automatically both the conditions can get evaded. Is that a possible way?
I think it's a possible. You have only two challenges. First of all, I believe it's a possible thing done in the past. The first challenge is that what you can demerge is only an undertaking compared to a merger where I think. So you have to demonstrate why that piece of land is an undertaking. That's the first challenge. Second challenge is I do agree with you that if it's a new company, then the condition which says for a period of 3 preceding years, XYZ, that is not applicable because it's an impossibility of condition. I'll just quote a very different regulatory this thing. Under the old Companies Act, there used to be certain conditions which said that if you are declaring dividend from past profits, then it cannot exceed the average of dividends declared in the past 3 years. And for new companies, there was an argument that I'm not even 3 years old, so that condition doesn't apply. But you had an MCA notification saying if you're not 3 years old, you cannot declare dividend from past profits. I don't agree with that approach, but you always have that risk. Where are you giving a tax office a chance to say that you're not satisfying this? But legally, if you ask me, yes, it's an impossibility of a condition. It should not permit. I would rather buy a 3-4 year old company in which I'll demerge this and then I'll convert it. Then the only issue which you have is GAR. But conceptually, this works, I think.
Thank you.
Yeah. Should we? Yeah.
Thank you, sir. So, sir, on behalf of WIRC, I would like to present a small memento. Sir, it was a wonderful session. You have very lucidly explained all the provisions relating to LLP and partnership firm. And I'm sure all the doubts have been addressed. If there are any doubts or any questions, you can connect with sir offline or you can send it to us and we will try to get it resolved. On behalf of WIRC, would like to give a sincere thanks for, thank you, sir, for sparing your time and sharing your word of wisdom. Thank you so much for, sharing your rich experience. Whenever, we are having a DTRC, sir is always available. Thank you, sir. Thank you so much. And I would also like to thank all the participants who are here for making this program a successful virtually and physically. Tomorrow we are having, a last day of, Mile Sur Mera Tumhara. We are celebrating a CA Day celebration. So if anybody would like to join, I request all you to join tomorrow morning. We are having a physical performance of over here and it will be YouTube live also. So see you on the next session on 9th of July. Thank you so much.
I'll check with Web. No problem. Nice.